Good afternoon. I'm Andrew Moss, Director for External Outreach and Minority Affairs and OCC's Project Reach. One of the things about Project Reach that we are excited about, and we're actually happy that all of you are here, this is really about our village, and we're happy to welcome all of you to be a part of that. And so the work would not be really going forward unless you were participating. And so I just want to make sure that everyone understands how grateful and appreciative we are here at the agency that you are being committed and dedicated to this type of work. With that, I just want to make sure that you understand that our role here is really about the convening, and it's about highlighting the work that's being done by all of the stakeholders. So as we begin today's program, the first thing I want to do is to kick off our first discussion, and that is with Acting Comptroller Michael Sue and FHFA Director Sandra Thompson. So at this time, please join me in welcoming Acting Comptroller Michael Sue.
Thank you so much, Andrew, and thanks for joining us today. Just to build off of a point that Andrew made, the real power of Project Reach is in the convening. And I am extra excited today that we're able to do this in person. Typically, we're on a screen, we provide, quote unquote, virtual coffee, which is no coffee at all. And this time, we are able to come together, and I feel already, I feel a difference. I feel that the richness, the quality, the quantity of discussions and ideas, and the power of convening has just gone up exponentially. So I hope to do more of this in the future. The other philosophy we have with Project Reach and the convening is to bring the best and brightest minds together. So today we have with us Director Sandra Thompson with FHFA, and we're going to be talking about, with regards to financial inclusion, one of the hardest issues with regards to financial inclusion has to do with wealth gaps, and the homeownership gap is at the top of that list. I don't have to go through the stats, you guys all know it. So we're going to be here today to talk through what it takes to close that gap and what needs to be done. And so with that, please join me in welcoming Sandra Thompson. Okay. So we're going to just do a little Q&A here. So the pandemic has highlighted the disproportionate impacts on underserved communities of color. And as you reflect on the challenges faced by those communities over the past 2 years, what's your perspective on the greatest opportunities to support financial inclusion?
Sure, great question, and thank you for having me. These challenges have existed for years and years and years, and one of the things that we're focusing on at FHFA is providing liquidity in underserved areas. And when we think about underserved areas, we could be talking about rural areas where we've been challenged with getting comparables for rural properties, and also in areas that would be amenable to manufactured housing, where you have to deal with the NIMBY type issues. And certainly we have been dealing for years and years and years with challenges in communities of color. Certainly when you think about redlining or steering, and even the losses that took place in the Great Recession in 2008, 2009, many of the provisions that were gained through homeownership were lost. When you think about the predatory lending, the 228s and 327s, all the predatory products, many times they were primarily working in the communities of color, and so people were disproportionately harmed. So any wealth gaps that were closed were reopened after the Great Recession. So we think that there certainly are opportunities to try to address the racial equity gap, especially through homeownership. We know that that is the largest asset that most people have, and so we've been working with our regulated entities, Fannie Mae, Freddie Mac, and the Federal Home Loan Banks on some initiatives that will address the gaps that exist today. One of the things that we've done is we've asked them to come up with some equitable housing plans, and year one, we've asked the enterprises specifically to to look at areas that previously had been redlined, to identify barriers for homeownership for persons who live in those areas, and then come up with some specific solutions to try to address those challenges. And so we're really excited about the plans that the enterprises have submitted to us, and we certainly are going to be laser focused on making sure that we do everything in our power to try to address this gap.
Fantastic. So as you look across the landscape, financial services, financial inclusion, what innovations excite you the most, and what are the risks? What are the risks with those?
Sure. So technology's come a long way, and when you think about how technology is used in the mortgage process, it is really evolving. I think the mortgage industry is probably the last to incorporate technology into the entirety of its process. And if you think about it, in 2021, that was a huge year for refinancing. I myself had to have a rate lock 3 times. So the process itself takes a very long time, and we think that technology can certainly be utilized in a greater way. Specifically, when you're going through the application process, both Fannie and Freddie now have mechanisms to use third-party validators. So when a borrower fills out an application, they have the ability to go to a third party and get income information or asset information. But one of the things that we think is a game changer is the way we look at credit scoring, and both Fannie and Freddie are incorporating rental payments into the underwriting calculations. And that's huge because, as you well know, when you're looking at a credit score, if you have a mortgage or if you've had a mortgage before, that will count towards building your credit score because a mortgage is a debt. But when you look at rental payments, they aren't counted. And so in most houses, rent or mortgage, the household expense is the largest expense that most people have every month. And so you're looking at, people across this country who've paid their rent, month after month on time. So Fannie and Freddie have both found a way to incorporate positive rental payments into the underwriting calculation. So we are hopeful that more renters will be able to have a positive mortgage experience because their on-time payments will be counted in the underwriting score. And when people think of Fannie and Freddie, typically they think of the single-family business line, but they also have a multifamily business line as well. And on the multifamily side, one of the things that we're encouraging some of the developers and sellers to do, and this is a Freddie Mac proposal specifically, they're working with a company that is gathering and reporting on-time rental payments for the multifamily property developments as well. So we're trying to incorporate technology and the utilization of rental payments in a number of different ways. We also are going to be updating the credit score model. We've used classic FICO for 20 years now. And when you think about the landscape and environment that was in place 20 years ago, people weren't paying, cell phones, certainly streaming services, things that are part of people's lives today that were not as prevalent, 20 years ago when classic FICO was introduced and is now being used. And so we're looking at updates to the credit score model that Fannie and Freddie use, and that is going to be hopefully a game changer just in terms of how they look at assessing credit, some of the factors that they take into consideration. But if you think about, again, the credit score, updating that model, it's going to have reverberations around the industry. So we want to make sure that when we make a decision that we take our time, because the time to implementation is going to be really important. People are going to want to calibrate like the existing FICO score to whatever the new score or scores are. And so we really want to be thoughtful about not just what we do, but how we do it. And so we're really looking forward to that. And we do think that that's a game changer.
What's really exciting, there's a lot of the themes that you mentioned, using rental payments, classic FICO, updating, are very consistent with, on Project Reach, some of the other work streams, like on Credit Invisible. So I think that there's kind of safety in numbers in terms of the direction of travel on some of those things. So, as a regulator primarily focused on housing, where do you see the greatest opportunities for financial institutions and community organizations to collaborate to reduce the racial housing gap?
Sure. So I would say this. So I've been working at FHFA for like 9 years now. Before that, as you well know, I was at FDIC for 23 years. So safety and soundness and access to credit are really, hand in hand. When we think about financial inclusion, one of the things that I've noticed when I look at the Fannie and Freddie books in terms of loan acquisitions, we find that persons in communities of color are tardy to the party, right? And so I'll give you an example. 2020 and 2021, record low interest rates, record number of refinancings for both enterprises. But when I looked at the end of 2021 at borrowers who had interest rates of 5% or higher, 5% of borrowers that were white had higher interest rates, 5% or below or above, and then 10% or almost double in the communities of color had interest rates of 5% or higher. And so now we're starting to see an uptick in refinancings for communities of color. And when you think about the environment today, we've seen interest rates almost double in less than 6 months. The word isn't getting out. So when you talk about inclusion, when you talk about what can we do, we really need to make sure that we can make sure that communities of color and underserved communities and people who don't necessarily have access to financial services are getting the same information that everyone else is getting at the same time, and that we are getting this information to trusted sources. Right. Because when we had the pandemic, certainly, and I'll just speak for Fannie and Freddie, we had a number of forbearance programs, and we were really active in making sure we were working with lenders, many of whom you regulate, but just so they would understand some of the flexibilities and options that they had. And so we have this payment deferral program where you could defer your payment, and when you were able to get on your feet again, you could start repaying. And so we, again, wanted to make sure that we got the word out about all the different programs and all the different options, but it just seems like the people in communities of color are always the last to hear about it. And when you're the last to hear it, sometimes you're the last to act or react. And so just trying to figure out a way to enhance communication when we have these, huge initiatives that can be very impactful. And when you think about, again, 2021, interest rates were, 2%. And if you were really lucky, you could get something with like a 1.95 handle. But when you're looking at the people who still had these interest rates, whether they were white, black, or whatever, you're looking at we looked at income as well, and these are the people who could most afford to take advantage of a payment reduction. And so again, just getting the word out, making sure that there's an awareness, and not just awareness, but if there's a follow-up. And again, today, we're looking at the refinance rate, and we're looking at people of color refinancing. And I'm not talking like a cash out refi. Right. I'm talking rate term refi. And so I just really, that is really problematic for me. The other thing that we're looking at is closing costs. When you take a look at, how much does it take to close, and you're looking at a small balance loan, and is it really worth it to pay, for a $250,000 mortgage, you're paying $10,000 and sometimes even as high as $17,000 in closing costs. And so, are there things that we can do to be helpful in the mortgage process? Can we provide information? Can we make sure people are mortgage ready? So those are some of the opportunities and things that we see that we can certainly get a lot of help from financial institutions and community groups.
Yeah, I know that in the REACH work stream, all of the large bank members of that affordable housing work stream now have programs, down payment assistance, et cetera, and just getting that word out is just really, really critical.
Yeah. You know, it would be helpful if we had all that information like in one place, because it's true, every state has like a different program, every state HFA or, you know, the banks and, you know, credit unions, I mean, all the financial service providers do have information, and it would just be really helpful from a borrower perspective to say, okay, you know, here's all these down payment assistance programs, or here's this, and here's what I need to qualify for that. And it would just really be helpful. The other thing that I want to make sure that we do is have this information available in multiple languages. And so we have recently required lenders to provide to borrowers the supplemental consumer information form, which we call the SCIF, but it contains information on, it's voluntary for the it's voluntary for the borrower, but it's mandatory for the lender. And it says, you know, have you had home ownership education or counseling? Have you had, what is your, are you a veteran, or are you, what is your race or gender, and all of that sort of thing. And just having that information available, we think is gonna be helpful, and also the language preference.
I know the language thing is especially important for Asian communities, because there's not one Asian language. You know, that's something that's really important.
No, exactly, and we've tried to have all of the mortgage forms, the very important ones, translated, and we work with the Library of Congress. We have them on our website, but we also have them on CFPB's website, because their website gets a lot of hits. But I do think that that's a very important undertaking, and we need to be thoughtful about how we communicate, and that we're communicating to a broader audience, and that we are including everyone.
You had mentioned earlier the FHFA Equitable Housing Fund. Can you say more about that?
Sure. So we, again, are focused on, you know, Fannie and Freddie, certainly you can do the bread and butter. They were over $7 trillion in mortgage-backed securities outstanding. And so it's easy to make a loan when you've got a, you know, 700, 780 credit score, 30% down payment, you know, 30% debt to income ratio. And there are fractions within our country that don't have those. And so we have made a concerted effort to really try to focus on underserved communities. And underserved, we've got rural communities, we have the manufactured housing communities, affordable housing preservation. We also have our affordable housing goals, where we look at both income, and we also look at areas. And one of the changes that we made this year is we had what we call the low income area goal, where we tell Fannie and Freddie, we give them benchmarks, and so many of your acquisitions have to be in low income areas. And what was happening was we weren't making the distinction between low-income areas and minority census tracts. And so every person that's low income is not a minority, and every person that's minority is not low income. And so just making sure that we have specific goals for low-income areas. And also we created a new goal this year for minority census tracts, because what we were seeing was a number of persons that had built the communities, that had lived in the communities for years and years and years, were getting displaced. And so we want to make sure that the people that did build the communities are able to stay in the communities if that's what they choose to do. And so we asked Fannie and Freddie to, again, look at communities that had previously been redlined and really understand and identify barriers. And once they identified these barriers, we asked them to think about coming up with solutions, quantifiable solutions to these barriers. And we are really excited about the plans that they've submitted. Many of the plans used special purpose credit programs, that have been on the books for years. They've been legal, but people have not used them. And thank you for your leadership. I know Secretary Fudge issued an opinion letter. You've issued an opinion letter, and so did we. And we're hopeful that lenders and sellers across the country will use these special purpose credit programs to be thoughtful and creative and intentional about ways to really address these issues in underserved communities.
Are there other FHFA priorities that are kind of in this space that you care to share? We have limited time, but care to share with folks today?
So, yeah, well, I guess when I have these conversations, and again, I've spent 23 years at the FDIC and at FHFA, I'm responsible for both safety and soundness and I would say consumer protection if I was at the FDIC, but access to credit. And when I say access to credit, people automatically think, oh my gosh, she's going to blow up the credit box and it's going to go back to 2008. And if I heard that once, I've heard it 10,000 times. And when I say affordable, I mean sustainable lending, because I did experience 2008. And there is absolutely no point in giving someone a loan that they can't afford or that they can only afford for 1 or 2 years. Fortunately, we don't have those products available anymore, but if you're not talking about sustainability, are the people ready to be homeowners? Do they understand the hot water heater or the refrigerator breaking down, the liquidity or reserves that you have to have, and just the commitment that it takes? And so there are a lot of different factors that go into homeownership. But when I think about affordability, I think about sustainability. And I want to make sure that if people are getting homes, that they're able to stay in those homes for the long haul. Because when you think about the disruption that took place in 2008, 2009, everybody lost. Borrowers had to be removed, families had to leave their homes. We had the highest number of foreclosures, investors, lenders. It was just a lose-lose all the way around. And we don't want to repeat that again. And so again, I think one of the priorities for me is to really articulate clearly and demonstrate that safety and soundness and access to credit are really two sides of the same coin, and that you can't have one without the other. Too much focus on safety and soundness, you shrink or diminish the liquidity, and too much access to credit without any parameters. Well, we've seen that story already. And so from my perspective, those two work hand in hand. They work together, and we're not compromising either. And I think that we can have an affordable housing finance system that has sustainable mortgage loans.
I think that complementarity, we have the same thing at the OCC, where we've got safety and soundness in our mission, and then we've got fairness, treating customers fairly, fair access. And often they're seen as a trade-off or a tension, and I think that's not quite right. I think it's actually, they're very complementary. You can't have safety and soundness without fairness, and you can't have fairness without safety and soundness because of that sustainability issue. And I think that it's a different mindset that we need to kind of take as we approach these things.
Agreed.
So what would be your call to action? You got a lot of folks here from a range of groups and financial institutions. What's the action takeaway?
So the action is, let's get to work. We've been having conversations for we've been having these conversations as long as I've been in Washington, which is a long time. And so conversations are really good and they're great. We've done as much due diligence and studying and research and papers and talking and focus groups and Zoom calls. But let's see some real measurable, quantifiable output. Let's see loans being made. Let's see, neighborhoods remaining intact. Let's see people getting loans. Let's see people understanding if they choose to be a homeowner, what that means. And let's really get the word out about homeownership, and because that really is one of the primary ways we are going to close this racial equity gap. But let's do it in a sustainable manner so that we can all move forward. The tide moves when everybody moves. And from my perspective, I grew up on the south side of Chicago, and it is just so important to me personally that we accomplish and achieve some quantifiable objectives. And so I really would love to not be able to come here and just talk about it. I'd like to make sure that we are about it and that we have actual loans, like we were here at one point and now we're here, or I should say here.
Yep. Amen. So on that note, I think that is a great place to end. I know that within the Project Reach context, I think the initial first year was a lot about convening folks, getting kind of the brightest minds together, identify the problem, craft solutions. There were a lot of process gains. I think you're right. Now we need to move from process to outcome gains. Right. And so I think that's a great place to end. Please join me in kind of thanking Sandra for a very nice fireside chat.
This panel is called Creating Paths to Affordable Homeownership. It'll be moderated by our Deputy Comptroller of Community Affairs, Barry Whitus.
All right. Good afternoon, everyone, and thank you so much for attending today's sessions. I'm the OCC's lead for the Affordable Homeownership Workstream of Project Reach. And I think Director Thompson and Acting Comptroller Sue really set up our panel very well in terms of laying out some challenges for us that we've, of course, all been working on, but really need to redouble our efforts. So today what I wanted to do was walk through a little bit about what we've been working on our Affordable Homeownership Workstream for the last couple of years. And I've been really pleased to be able to work with 11 of the largest bank lenders, scores of community leaders, civil rights organizations, think tanks, and Native American organizations, really looking at some of the barriers and ways that we, working with the banks and the community leaders and other regulators, can address some of the challenges that Director Thompson talked about a few minutes ago. I have been very fortunate to work with Christy Furco, who's the Executive Vice President and Head of Wells Fargo's Home Lending, who's done a great job, yay Christy, who's done a fantastic job leading our Affordable Homeownership Workstream for the last couple of years. And it's really exciting to do this today, mostly because it's an opportunity to meet everybody that we've been working with on Zoom for the last 2 years. We've accomplished a lot, but I think we have so much more that we can do. So thank you, Christy, for taking the lead. To Christy's right is Lot Diaz, Vice President in Housing Financial Empowerment at Unidos US, who leads our subgroup working on connecting mortgage borrowers who've received denials with housing counselors who can get them on the road to homeownership. So thank you very much, Lot, for your work in that effort, and look forward to your comments today. To Lot's right is Jason Fraley. Jason is Community Lending Director with Huntington National Bank, and Jason leads our group that's working to fight appraisal bias. And very much appreciate the work you're doing on that, Jason, and look forward to hearing about some of those efforts this afternoon. To Jason's right is Eric Schmidt. Eric is the Managing Director and Home Lending Product Innovation Executive with JP Morgan Chase. And Eric has been leading our efforts to identify ways to more effectively and efficiently preserve homeownership for people who are having difficulty making their mortgage payments. As Sandra mentioned, we saw a lot of loss in minority homeownership during the last financial crisis in 2008, and we want to make sure we learn from those lessons, and Eric's been very instrumental in our work on looking at ways to improve that type of servicing. To Eric's right is Neil Whitecoal. Neil is with the Ho-Chunk Nation and he's Executive Director of the Housing and Community Development Agency. And he's working with Tony Walters to his right, who's the Executive Director of the National American Indian Housing Council, who's one of our co-leads on our subgroup looking at ways to address barriers to financing owner-occupied housing and development in Indian country. So hopefully over the course of our discussion over the next hour, you'll get a better sense of what some of the issues we've been working on are, what some of the challenges are, and ways that we can work together to move these issues forward. I'm going to start by asking Christy to kind of lead us in the first discussion around the appraisal bias, what we've been working to do in that realm, as well as some of our work around connecting housing counseling agencies with borrowers, and particularly borrowers who've been denied mortgages. So Christy, tell us a little bit about that work, as well as the other work that you see as important and what we've been doing in REACH over the last couple of years.
Yeah, well, thank you, Barry, and hello, everyone. It is great to be with you. I'm excited. We talked earlier, our group got together and we said, many of us only have a Zoom relationship. So to be here in person and get to see each other is really exciting. This Affordable Housing Working Group is probably one of my favorite meetings that I have every month. I'm inspired by the work that we're doing and the power of this platform that the OCC has put together that we all get to operate underneath. It's not only about what are we driving as our individual companies, but then the collective energy that has been created in these individual work streams, and the affordable housing work stream has been extraordinarily powerful. The word that keeps being said, and I think we're going to continue to hear it all day, is this collective, because it really is demonstrating this alchemistic effect of what we can all do as individuals is great, but what we can do as a collective is even better. And I'm so grateful to the OCC for the platform that they've put together for us to be able to do this. I wanted to just ground you guys in the work for the affordable housing. And we set out at the beginning of, or the end of year one, as we were going into year two, we said, what's our North Star? What are we really trying to drive forward? And I want to share those principles that we came up with, which is the Project REACH Affordable Homeownership Workstream is centrally focused on sustainably growing minority household wealth by increasing minority homeownership rates. U.S. Census Bureau Q2 of 2021 data shows that homeownership rates for minority households significantly trail that of white households. Bringing the minority homeownership rate to closer of that of white households can play an important role in reducing the minority wealth gap, as Americans' primary residents account for roughly 25% of overall wealth. And as we really take on the work in these work streams, we're really cognizant of the fact that unwinding these systemic inequities that have plagued housing for literally decades is going to be monumental work. And so it really is critical that we all come together and be able to drive that in a substantial way. And so Project REACH is the perfect kind of platform for us to really be able to do that. And I want to just share some actual results, because Sandra Thompson said, let's get about it. And I am really pleased that the member banks, as Barry talked about, that are a part of this work stream, we have actually driven some quantifiable results over the last 2 years. And so, we have offered a range of specialized products for low and moderate income communities and borrowers. We've had over $32 billion has actually been lent to more than 175,000 homeowners under the programs that these lenders offer, and nearly $1 billion in down payment and closing cost assistance and grants and forgivable loans have also been provided to these borrowers. So there is that is substantial, but we recognize that there is more work to do. So as Barry said, over the next hour, we're really going to engage in a discussion to talk about some of the great work that we have been doing as a group. So I want to first get started with Lot and Jason and really welcome you guys. And I know this has been near and dear to your hearts as you've been focused on the appraisal work. And so, you guys come from two different perspectives, obviously, with the work that you've been doing, but are certainly comrades in this as well. And so I'm wondering if you can just start, and Lau, we'll start with you. What challenges are we working to address, both relative to the specific efforts, but then also across the work stream more broadly?
Yeah, well, hi everyone. Pleasure to be here. We came into the effort through the adverse action stream, which is a area of work that was dealing with lenders, the borrowers, lenders, applicants were serving who could not meet the credit, who could not fit in the credit box. And so what do you do? I remember years ago, about 3 or 4 years ago, I had a colleague who did a pilot with some Southeast regional banks. They captured 500 into a counseling stream. They tracked that 500 from 12 months after entering the stream. When they were done, almost 60% had closed in a mortgage. So that experience plus a very unique event happened. Freddie Mac's a couple years ago funded a collaborative of HUD intermediaries and other agencies. It was led by Housing Partnership Network, and Megan McCarthy has been taking a lead on that. And what they sought to do, how can we make these, how can we hit 60% from denied borrowers systemically, right? If it's done in a sample, can it be done broadly? What became the housing integration, Housing Partnership Integration Initiative, HPII, I'm going to call it that, really sought to do two things: look at the technology interface between housing counseling agencies and lender platforms, and then what is the program design that can be adjusted to make sure you get pull-through rates that are much more effective. The result of that 18-month process was 2 projects. One was a data project that's really working with housing counseling CMSs to adjust them and work with them so they can more easily link up with lender platforms. And the second project, which intersected with the adverse action work stream, was HPII and the program design. And what was done there is really finding a way to kind of create an interaction where the work of housing counselors, which is substantial, they're essentially underwriting the family before they would go to the lender, and that's kind of the best way to do it, because you have a fully educated, fully prepared. They even have collected docs. That work is hardly ever captured in the origination process, and it's a damn shame, I have to be honest. It makes double work for the borrower, it's double work for the lender, it's frustrating for the housing counseling agency. So how could we create a system that would change that dynamic? And so the HPII group did it. There were several intermediaries. I know Home Free USA was there, National Urban League, NCRC, and there were several others who were participating. We came through with this program design, and at that time, Wells Fargo's leadership was very active in the adverse action work group. Had a conversation with Megan, and that's where the two connected. And so for the last probably, about 4 or 5, maybe 6 months, we've been trying to work with the lenders. How can we change the model? How can we work with the model so it could fit into your systems where your denials can get referred to a housing counseling agency and get not only the education and support, collect appropriate documents, and then support the borrower as they finished, work with the borrower as they go through closing with the lender, the chosen lender, and that's working with us. So it's really trying to tighten up our relationship so there's less leakage. The last thing I'll say about it is that the pilot is designed to collect a lot of data, because what we want to do, where I said 60%, we're successful after 12 months, we want to be able to quantify that and even more granularly understand the impact of the housing counseling service with the origination and underwriting processes. So a lot of this, kind of magical, mystical talk sometimes about the process can be more quantifiable and understandable by industry. So,
That's great. Thank you.
So as the name suggests, the equitable valuation workstream is designed to take a look at what are the causes that lead to borrowers getting valuations on their home that are based on the color of their skin, but not the actual quality of their home, not the value of their home. And I will be clear that I will use the term appraisal and valuation interchangeably, much to the frustration of my work stream sometimes. Apologies to all the appraisal and valuation professionals in the field. As a lender, I came into the conversation with two kind of selfish motivations that I think have turned out pretty well. One is, what can lenders do to help address appraisal bias, recognizing there are certain regulatory constraints on what we can do? Obviously, we can't influence the value of an appraisal. And then tied into that is, what are the blind spots that we have in the lending industry where we could potentially help out more than we realize? Sometimes as lenders, we get fixated on what regulations prohibit and lose sight of the creativity that we still have in order to drive change. When we've structured the work stream, we've taken a look at it in two different ways. One is there are immediate proximate causes, we believe, that result in borrowers getting valuations that are undervalued or biased. And sometimes that can be lack of education both on the loan officer side as well as the borrower side on what appraisal bias is and how to address it. And there may be other proximate causes such as lack of transparency around reconsideration of value or dispute processes. And then there are longer term structural issues. Everyone is pretty familiar with the lack of diversity in the appraisal industry. There's questions about the efficacy of certain USPAP guidelines, questions about the education that it takes to get into the industry. We have structured the work stream to address the former issues most immediately because I want a work stream that errs toward action as opposed to more conversation. And what's happened fortuitously is the PAVE task force report's been published that addresses some of the broader things that we're now in a good position to address with where we focused our efforts initially.
So can you just build on that? Because I think PAVE, and hopefully everybody's familiar with the task force that was with our Vice President, Kamala Harris, and HUD Secretary Fudge. But the report was pretty powerful, and I think they really did set forth some clear actions that the industry could really focus on. So what are some of the solutions that we're pursuing in the work group?
Yeah, so we have driven two main outcomes so far in the working group that's going to lead us to address some of the broader items in the PAVE report. So everyone calm your excitement. I mean, we're going to talk about disclosures here to begin with. I know everyone's favorite topic. So one of the things that we believe is that there's a lack of transparency around what to do when you feel like you've been subject to appraisal bias. And so what we've done is let's take a look at the disclosures that borrowers receive during the application process and figure out, can we help them become aware of what action to take if they feel like their valuation is wrong? And so when we talk about disclosures, we're looking at things like the cover letter that comes with an appraisal. We're taking a look at the appraisal waiver form, even the adverse action notice, because certainly collateral value can play a role in a borrower's denial. And so we've tried to accomplish a few things by remaking some disclosures and providing template language to lenders. The first thing is we want to make sure that borrowers understand what an appraisal is and that appraisal bias is against the law. It seems kind of obvious, right? But we all deal in this stuff every day. A borrower's engaged in a home transaction every now and then in the grand scheme of things. And so we feel like outlining that is a critical first step. And then the second thing we've really tried to accomplish is provide clear, tangible direction to borrowers on actions they can take if they feel like they've been subject to appraisal bias. So what email address or phone number can you use to request a reconsideration of value or to submit a dispute? Are there resources outside of the lender that you can go to complain in the event that the lender is unable to resolve your dispute satisfactorily, or you just don't feel comfortable going back to the lender? We obviously want the borrower to come back to the lender because the lender should be aligned with what the borrower wants and getting a fair valuation, but we're providing both options there. The working group believes that everyone, for the most part, has a reconsideration of value process, but it's really unclear how transparently that is provided to the borrower. Some lenders will do it. I think this is probably the most likely outcome. They will provide it when a borrower has a complaint. Oh, I'm upset about my valuation. Well, here's how you go through this. Some borrower or some lenders may do it more frequently. They may do it to every borrower. Some may not do it to any. What we're trying to drive with the template disclosures is you'll have something that you'll commit to that will be in every disclosure package. You obviously have to have the controls and processes in place in order to provide those disclosures and try to drive industry adoption that way. And every lender who's part of the work stream has agreed to use some version of those template disclosures going forward. So that's very exciting news. I'm happy about that. The second item we're trying to address are best practices around appraisals in general within lending institutions. So what are some best practices around loan officer education on appraisals and what happens when they have a customer complaint around bias? Are there certain collateral management or collateral valuation department controls that make sense to have? Are there certain reconsideration of value best practices that every lender ought to have? We're pretty much done with the disclosures. Those are under review by Reach leadership, and this work effort is coming forward probably about the next 90 to 120 days. We should have all of that reviewed and a recommendation made around best practices. Neither one of these, as far as I know, Barry, you can tell me otherwise, are going to be binding regulatory guidance. But we hope through some peer pressure, we can compel folks to take action. Like I mentioned earlier, all the lenders who are part of the work stream have agreed to use some version of the template disclosures. But in addition, there are many that have said, we're going to go above and beyond. We're going to provide more education to consumers to help them really understand what an appraisal is. If you, the GSE equitable housing plans were mentioned a minute ago, at least one of those has reference to appraisal bias into the specific work that we're doing because the GSEs are part of this work stream and they've bought into it. Like, those are fantastic outcomes. The idea is that we can help provide some baseline action that can then spread through the industry with like-minded individuals. And again, we think that this work ties in nicely to PAVE just by good fortune because we were started on it well before the report came out, but now it puts us in a good position to iterate further.
That's great, thank you. So Lot, can you talk about some of the solutions that the HPII group is focused on?
Yeah, well, yeah, I just, the work stream, sure. The work stream itself started with, like, how can they make the adverse action letter communication more effective for the borrower? More clear language, a second review period, how is that implemented? And there are other ideas. When we were, some counseling agencies were participating, we said, listen, we know that a denied borrower is a motivated borrower, and if you can provide a little extra support and guidance to get them that motivation, turn them from a frustrated denial into a hopeful potential homeowner, you know, that's the process that a counseling agency working for a lender. That's what counseling agencies do if they're doing their job in the best way they can. So the one outcome we came up with is that there's been the lenders who are participating are considering a program design that was been discussed over a period of 6 months. And we're trying to get everybody on board. Many lenders have current partnerships which are great. I mean, there's this particular HPII partnership is not meant to solve all the world's problems. It's meant to really test a different type of relationship that we feel takes full advantages of the expertise at the lender and the HCA and creates a playing field where that can be captured in a much more efficient way. And so right now we're kind of this final stage of getting lenders participating and hammering out the final details of what that model is going to look like.
That's great. So you both in your comments talked a little bit about how the collaboration that's happening kind of across lenders that are in your work streams, but I'm wondering if you can elaborate on how this Reach platform has really helped accelerate the outcomes.
Yeah, so Reach has created this proverbial safe space where lenders, GSEs, industry advocates, civil rights organizations, nonprofits, we're all getting together every month about the same time, about 60 minutes, to work through items that address the same topic. And that sort of rigor is critical. It's pretty frequent that we all talk to each other, but it's uncommon that we do it in such a regular, sustained way. It's one-off conversations, it's a how you doing at a conference, things like that. By getting together regularly with the discipline that OCC has provided through Reach, we're able to make tangible progress. And we know that if we don't resolve something one meeting, we're going to be getting back together the next month, and we're going to need to work through it. So it compels people to move forward rather than just say, well, we agree to disagree, I'll see you next quarter at whatever conference we see each other at. So that's been valuable. The other thing is, at every meeting we've had an OCC representative there, which has been fantastic. And they're not there to wield the regulatory cudgel. They're there as a peer. We're talking best practice amongst ourselves, and they're participating and providing feedback and comments just like everybody else is, which is fantastic. Though there are times when there's an impasse and the OCC does weigh in, that can be pretty helpful to move things along. There are times you should pay attention. So that's also been really helpful to have the regulator there letting credence to the work and also partnering to provide expertise. That's fantastic.
Great. Would you add anything?
Yeah, it's an interesting, it was like we had a group that was needing a venue to talk to lenders about what we were trying to do, and then Project Reach set up a dialogue with industry that facilitated that conversation a lot, and so those kinds of conversations are really critical to find solutions, because as you know, change is like the hardest thing I've ever seen in my life, and getting a conversation that might lead to change is the hardest thing I've done in my life, and this venue was a critical place for that to happen.
Yeah. So as we wrap up this section, what's next? As we go into year 3 now, what does that look like?
We have a little bit of a regulatory hurdle to get over. CFPB ended the no action letter policy at the most inopportune time. And so lenders were going to use that within our project to kind of codify some of the Reg Act RESPA risks that they see potentially in the relationship. CFPB has been clear with us saying that their letter to HUD, their no action letter to HUD, as long as a project, and this stays within those 4 walls, that there shouldn't be an issue, but that's not necessarily comfortable for all legal teams. So we're trying to look at strategies to either assess if that's true, or to what other strategies are possible to kind of get the regulatory issue off the table, because that's the one issue we have to worry about.
So I'll just jump in here to Lott's point. So we have different regulatory jurisdiction over particular issues that affect the home buying process. And so the ones that Lott mentioned in terms of the Real Estate Settlement Procedures Act is one where two agencies have to determine what is an appropriate level of compensation that sort of passes muster. And so, we think through involvement of the CFPB and HUD in these discussions that we have, particularly around the counseling issue, we're able to clarify the issue and then determine, who has jurisdiction over solving that question and how we bring it to closure. So while it's frustrating that we don't have, a no action letter process anymore through the CFPB, I don't think that necessarily has to be an insurmountable obstacle to resolving it. You'd think that these were easy issues, but we do have statutes that we have to work through, and I think we can, and I think the REACH process of having so many banks that are interested in doing something around housing counseling and compensating counseling agencies for their excellent work in terms of helping prepare borrowers or helping borrowers who have been denied, is something that we can make progress, as Sandra and Christy said, make some progress on issues that we've been talking about for a long time, and this is one where HUD is now in the right place and the CFPB is coming to the right place, and hopefully we can ultimately end up with a system where banks can compensate housing counseling agencies for helping to prepare denied borrowers for future homeownership. And we know that has huge implications from a racial equity standpoint. The black denial rate for purchase mortgages is 24%. The Hispanic is about 19%, and the white denial rate is 10%. So to the extent that we can help people that have been denied who still want to and are motivated to homeownership, a pilot like the kind that Lot's been talking about can help really move the mark on that. So I'm really thankful for the work that you're doing, Lot, and the HPI, the folks from the Housing Preservation, the Housing Partnership Network has been great, and really thank you for your leadership, and thank you, Jason, for your work on the appraisal. We're gonna get to that disclosure and the best practices, and we'll move on to other issues that have been identified in the PAVE report that banks, I think, have the ability to make some impact on. So thank you for your work.
Great. Anything else on what's next as we transition?
Barry did a nice job. I must have shared my notes with him. I started by saying we want to err on action. We've taken action on 2 tangible items, and the goal is now let's transition into the bigger structural issues that PAVE helped identify, and can we find some other allies in the room to help us with that, or can we provide leadership, or are there places we can link up with efforts already underway? That's what we're going to be looking for next as we transition.
That's great. Well, thank you, gentlemen. So now we're going to transition to our second panel to talk about some of the homeownership challenges that we've got in our Native American communities. And I am pleased that Tony Waters and Neil Whitegull are here. And really would love for you guys, let's just start talking about and educating the group a little bit on what are some of the challenges that we're seeing in the Native American communities.
Sure, well, I'll start off, and want to first thank everyone involved with Project Reach just for recognizing that there are differences and unique challenges for homeownership in tribal areas, tribal communities, and getting us involved, inviting us to be part of the group. So have a lot of great discussions. Thanks to all of you all who have participated in those kind of subcommittee discussions. There's always room for more. So if you haven't been a part of those yet, I invite you to be to start joining us for those conversations as well. But it's mostly an education and an awareness issue, and I think you've heard it already kind of through some of our discussions. You hear a lot of data points. You rarely hear a Native American data point included in that because it's just some of the barriers that they face. If you look at the populations, 2 to 3% of the population of the United States are Native. And that's spread out over 34 states, 574 distinct federally recognized tribes, tribal reservations, tribal communities. So you start to see how that kind of gets spread out and kind of dilutes any kind of impact that you can really try to make with some of your time and investment. Those tribes themselves can go for anywhere from between 50 to 100 tribal members to 2 tribes that are over 400,000 members in the country. So it's really hard to create those kind of scalable solutions too, right? That you can apply for some of these smaller tribal communities and make work for the larger communities as well. So a lot of it is just kind of creating that awareness for each of you in this room. If you have tribes, if you have a geographic footprint, obviously I encourage you to reach out to those tribes. But anything that you can do investment-wise, there's a component that can include and incorporate tribal communities as well. So I encourage you to look into those and reach out to us at NAIHC. We're a housing council, is our nonprofit. We're formed, and our members are the tribal housing programs across the country. So about 300 or 400 tribal housing programs similar to public housing authorities, but they focus wholly on the tribal communities that they serve. So always some inroads there to make, and happy to bridge you and connect those dots. A lot of our work is connecting dots. It's connecting you to tribal communities, it's connecting the tribal housing programs to many of you, and navigating the maze of some of our federal rules and programs that are out there as well. So every demographic has its unique obstacles and barriers. I think tribal nations, Indian country, very unique. Tribal governments are another layer to that, providing the assistance to their own members in their own jurisdictions. Trust lands are issues there. So these obstacles are there, and I think that's probably deterred some of you in the room from probably trying to push some of your services and products to tribal communities. But there are people acting in that space, so it can be done. It is being done. It just needs to be increased in greater volume. So definitely some obstacles there. Project Reach has really helped us create that awareness across banks and other organizations to recognize that need and challenges that we face, and still try to get engaged. So and Neil's here, of course, talking specifics on the grounds and what some of those challenges look like for you at Tojan.
Well, again, thanks for the invitation and the ability to come and share. And I think for those that don't know, I heard a term today, and I don't know where I heard it, but as far as like the invisible Indian, as far as looking at housing finance or homeownership opportunities for tribal members, and that that Native Americans are out there, and we have tribal governments, and they are unique, and I think that is one of the challenges that possibly the banking industry has in dealing with tribes, because every tribe, I'm from Wisconsin and the Ho-Chunk Nation, with 7,500 tribal members, and there are 12 other tribes, in Wisconsin, and we all think we're different, and we have our own separate tribal governments, and you go across to Michigan and to Minnesota in our region, and again, the same, we're all Native Americans, but we have our own tribal identities, our own tribal governments, the way we do things, and our unique challenges. Ho-Chunks are very fortunate. In a sense, we're fortunate that we don't have a reservation, but we have scattered sites, and some of those sites are near economic opportunities for tribal members to work and to be near banks, but a lot of tribes have no access to banking whatsoever. There was a story, Roger Boyd used to be the Deputy Secretary of Indian Office of Native American Programs at HUD, and he came from the Navajo Nation, and he talks about 30 years ago there was one ATM on the reservation, and you talk about access to banking and some of these opportunities I think that banks possibly could have as developing customers in that challenge of building homeownership and the credit counseling. We have tribal members that have no idea how to build their credit. They've never had a savings account. They've never had a checking account. And that's where I see it as opportunities here, because we have seen where people do have access, our tribal members at Ho-Chunk, utilizing the Section 184 program, loan guarantee program through HUD. I think we've turned out close to 400 or 500 tribal members that are now their own homeowners, and that over the past few years, and utilizing just regular mortgage notes within our tribal members. So, and that was through the launch of a Ho-Chunk credit union, and that was sold to another bank, and another bank bought them, and then they moved away. But so there was a success there, but that was access that many tribal members still have, even though that bank isn't near us anymore. Lots of our tribal members still have. That's the only bank they've ever known, and because they had that access to that banking. So I see those as great opportunities. It is challenging, again, going to what are those resources that tribal members need to become homeowners. But I think we also have lack of investment, not just for home ownership, but for my organization of developing rental housing. A lot of banks are just leery, or they don't know how to come to tribes, and what guarantees, or because it is on trust land, where are you going to have your protections? And tribes do have those protections. We have our own tribal courts, and your dollars will be protected. And many programs through HUD, the Title VI program is a HUD guarantee program that we utilized, a $6 million loan many years ago. But there are opportunities out there. But the part though I wanted to make those, we are all unique a little bit, so you can't paint us with one brush and say, okay, this should work for everyone. So I guess take the time and opportunity to look at, to reach out to tribes.
It's actually really helpful, Neil, so thank you for sharing that. And Tony, I'm wondering if you can expound then on how this REACH platform has really helped bring greater attention to some of the challenges that Neil just shared about tribal communities.
Yeah, well, I mean, again, it just goes back to awareness and education. I think one of the big things that our subcommittee did was put on a webinar, I think it was back in January or February this year. Hopefully it's available through OCC, and you guys have seen it. If you haven't watched it, I encourage you to go see it. But it just really outlines all the ways that you all can actually get involved in Indian country, whether it's direct mortgage lending in tribal communities. If you don't want to have that footprint, you can purchase those mortgages from local lenders, from native CDFIs who are in that business, to free up their capital to relend. There's a 100% guarantee, loan guarantee for home ownership in Indian country, 100%. So when we talk about low risk, those things are there because we know they're needed to create those incentives to get private capital into Indian country. So there are a number of programs out there. Our webinar went through all of those and talked about low income housing tax credit projects as well. A lot of tribal communities use those for rental housing that transfer into home ownership units after the 15-year period for those projects. And then just any type of investment in tribal communities is going to go a long way. As Neil mentioned, a lot of tribal communities are outside of more traditional economic opportunity areas, right? You're not seeing big business, you're not seeing urban areas or things that come into play there for a lot of our tribal communities. So any investment that you make, whether it's economic, creating businesses in these tribal areas, or directly for home ownership or even rental unit construction, it's going to go a long way for our tribal communities. So it's a lot of that. As part of that, we've had relationships from NIHC's perspective with a number of organizations and banks for years. One particular thing that has come out of this is our collaboration with Wells Fargo this past year. We've created a tribal housing resource assistance hub. So if you go to our website, there's a whole map there for any Native American across the country. I don't know the statistics, but a good chunk of Native Americans actually don't live in a tribal community. They live in urban areas. Myself living in Washington, D.C., for instance. So, they need to know where they can go for resources. And some tribes are able to, provide home ownership assistance, rental assistance to their members wherever they are. My tribe in particular, the Cherokee Nation out of Oklahoma, they were able to provide rental assistance or homeowner assistance funds to anyone, wherever you are, if you applied and you met the eligibility requirements, of course. So a lot of it's that creating that awareness. I think we've reached out to a large number of you all and banks in the room to try to promote that website itself. So many of you may have Native American borrowers that you wouldn't necessarily track that separately, but they will want to know where they can go for that type of assistance. So I think we've reached out, and that's because of Project Reach, is having that greater contact sheet, that contact list, and outreach to all of you, and connecting those dots both ways. A lot of the banks we've talked to said, wait, are tribes doing HAF program, Homeowner Assistance Fund? We thought that was just the states. No, you're going to have about 200 or so tribal housing programs across the country distributing HAF funds to members in their community. So that's a awareness that a lot of folks didn't know, but we're here to bridge that gap, and Project Reach has done a great job of doing that. Some of our next steps are really looking at the federal programs and why they aren't working as well, and what can we do to improve those moving forward. And a lot of it will be feedback that we're getting from our partners through Project Reach.
That's great, very helpful. So Neil, what does success look like on the ground?
Well, success does look like, again, we've turned low-income renters, and the only investment opportunities really has come for our tribe for years and years has been government programs, and utilizing whether it's HUD programs or rural development USDA programs for that investment or home ownership opportunities, writing a grant where we've empowered tribal members to go out, we use Native Pathways, housing counseling services, down payment assistance programs, go out and reach out to banks. And that, again, talking about that Section 184 program, these very secure mortgage notes, they're underwritten 3 times, once by the bank and once for HUD, and then they do another underwriting before they give that guarantee. And I know that has been a problem with a large number of banks in the past, that it took HUD a long time to get that guarantee, in hand. But we look at those opportunities, or here was working with partnerships, our local little banks, in Wisconsin. Other tribal banks have stepped on board. Wells Fargo has been, was a great partner for a long time with those Section 184. So we have taken that. Again, we did. I think it was with Chase Bank a long time ago. So there has been investments, and we've had tribal members, default on a couple of those loans, but we've had many more tribal members go through and purchase other houses. I think that downside, though, is we're not seeing the benefits on the trust land, and I think if you look at that map of Section 184, or the investment for reservations, it goes to near reservation boundaries, and that goes back to those same resources as mentioned here of challenges of getting an appraisal on trust land, but it's easier to get off trust land. So looking to build that capital, because with that equity, we heard that equity investment for Americans to utilize that home, and the same thing with business development, of having tribal members be able to use that house that they purchased to finance their business, so start up a new business, roofing companies, or the same people that are building those houses to build more houses. I think that's where we have seen that success of tribal businesses being able to start, from the equity of their homes, and that really has not been something on tribal lands that many reservations have seen in the years of if you're living in a HUD rental or a mutual help home, you have no equity, especially building up that years and years and years you might have low rent, but if there's no banks to put money into savings, it literally does go in a can in the backyard or wherever they're saving their money. And you can't take that back to you guys and say, I'd like to start a roofing company. I need a truck and a ladder. And say, well, where's your payments or where's your equity? And so I think that's where we have the opportunities of, we've worked with our local CDFI that we help start to do those microloans and then to get them into our partner banks. So that's where I have seen the success for the Ho-Chunk side and those other tribes that are starting. I think over in Montana, the Salish and Kootenai tribes, they have a great housing market themselves on a reservation. They do trust land and fee simple, so they have a whole system that I think for 20 some years now, that you see a successful housing market where they think they're their own realty company also. There's a group in Minneapolis, so again a nonprofit housing group. American, I should know that one, but it's American Indian Housing Corporation, AICO, but they're in Minneapolis and they actually started their own realty company. So they go out and they sell to tribal members and they use that for capital to make sure tribal members, they take a little bit to keep the doors open, but then they started listing properties. And so it's really turned into a housing market right there for that organization in Minneapolis. So you have, again, different, these tribal organizations are all a little bit different and they have different challenges. So, but there are more and more, as they can find partners and to give that money on reservations or for investments. There's a lot of success there. That I think the other one I'm just remembering is Comanche Nation in New Mexico. They do housing finance there through partner banks in the area, and they have just really developed their reservations. They put in the infrastructure through the HUD programs or the other government programs and have these lots available for tribal members.
That's great. Well, our time has gone quickly on this one, and thank you guys for educating us on the challenges of the tribal communities. I'm wondering if, Tony, you'll just close us out with just one last question. What's the top thing that you would like the audience to really understand about the opportunity that exists in tribal communities?
Sure. Well, I think just a reminder that the opportunity is there, right? There's a HUD report from 5 years ago, 68,000 units are needed in Indian country. We are afflicted with overcrowded homes just based on a housing shortage in tribal communities. So where you see that need in tribal communities, that just means there's the opportunity, right? That's why we're all here. We all understand that. To Neil's point, if you're the one investing in that type of project in one community, you're going to be the only name that they know in that community for the next 5, 10, 20 years. So just realize that there's opportunities there, there's investments that need to be made, and really it's just kind of avoid those blind spots. Everyone kind of sees tribal communities and say, well, someone else is taking care of that, a tribe's taking care of that, federal program's taking care of that, or maybe a state. Everyone's kind of like pointing another direction, but really it takes all of us to do that, and where those other actors aren't able to meet that need, you guys are right there to come in and take advantage of that opportunity. So really encourage that, and really just encourage creating that awareness and getting involved in our groups and conversations.
Great. Thank you guys so much.
I just want to say one thing that I found particularly useful as a result of the feedback that we're getting from the Native American homeownership subgroup, and that is that we're part of, at the OCC, we're part of the White House Council on Native American Affairs, and then we also participate on an interagency group called the Lending Systems Focus Group, and both of those efforts have as part of their goal to increase the access to capital for homeownership and housing production in Indian country. So we have the ear, fortunately, through those groups of the people running these programs, the HUD 184 Homeownership Loan Guarantee Program that you mentioned, and on also the United States Department of Agriculture offers a loan guarantee and direct lending assistance in Indian country. And they have told us that they want to increase their capacity, and they really rely on lenders to get their products out to the market. And so what this group has been very helpful, both from the lenders that have used these programs as well as from the Native American housing organizations like the NAIHC, is to feed back to these agencies what adjustments, reforms they would need to make in order to make them more appealing to lender participation. And we've just begun that dialogue over the last few months as a result of the work that you all have done. So I have found that personally very, very useful in terms of our work in advancing the work of Project REACH. So thank you for both of you participating in the group and the continued feedback that we're getting that can help move the needle on this. So thank you for your work.
Great. Do you want to transition to our final panel?
Indeed. So for our final discussion here during our session today, I wanted to dig a little bit deeper on some of the programs that the member banks are offering to advance minority homeownership. So Christy, maybe I'll start with you. If you could tell us sort of what you've, as a bank, have gotten out of this effort, what you've come to the effort with in terms of your various initiatives to promote minority homeownership, and from your perspective, how can we be helpful through the collaborative work of Project REACH, the partners, to help you achieve even more in the future?
Yeah, well, thank you for that question. So I've been the head of home lending at Wells Fargo for about 2 years now. And as the only Black woman leading a mortgage company, right? No, that's not yay. We need more of me. It has, this is obviously a personal passion of mine as well. And when I joined Wells Fargo, it was a true desire to wanting to help more communities of color achieve the goal of homeownership. And I was really grateful to join a company like Wells Fargo that has been leading this effort for decades as the largest lender to communities of color. And in addition to the Dream Plan Home down payment assistance program that we've provided, the Dream Plan Home closing cost credit, which gives $5,000 of closing cost credit, we really challenged ourselves around how do we take this to the next level. And you've heard from people on the panel, a number of the things that Wells Fargo through our foundation has really done in leading in this space. But the special purpose credit program was one in which we really saw that there was an opportunity. As you think about how entrenched this issue is around some of the racial inequities, we got to get uncomfortable to really drive some different experiences in this space and to change the outcomes where we are today. And the special purpose credit program, when the HUD Secretary, I think, paved the way for that to really happen in December, really provided an opportunity for us to say, okay, how do we lean in? And I think the REACH team and this platform has really been helpful for us to understand as we crafted our program. You made the legal team available for us to really understand what some of the legal challenges were and how to structure these in a way that was consistent with the guidance, but really then just the collaboration of the other partnerships. So in April, we announced that we would be launching a special purpose credit program. Initially, we would start with Black homeowners who are in Wells Fargo's portfolio who actually didn't have a chance for whatever reason. Either they were denied through the process and are still in our portfolio, or they just didn't take advantage of it, which unfortunately the numbers that Sandra shared earlier, is many communities of color just didn't take advantage of these historically low rates. And so we committed $150 million of Wells Fargo money to actually buy down the interest rate to be able to help these communities of color. So we started first with the Black community. We actually launched our program a couple of weeks ago. And actually last Wednesday, we closed our first loan. So really excited that this is, it's real. It is in the market and real. So we started this phase one is FHA customers that have an FHA loan. We, regardless of what their current interest rate is, we're going to buy down the interest rate to 3.75%. and we are working through the process. So we've done our solicitation. It is targeted outreach and solicitation to these customers who are in their portfolio. Wells Fargo is going to cover all the closing costs. We're guaranteeing that 3.75%, and we are working through the process. But I think some of the challenges, as we are, again, we're 3 weeks into the launch here, but some of the customers are saying, is this real? Like, is this, you're really doing this? And why are you doing this? And so it's really getting people on the phone, and there's a huge opportunity around this education. Again, these are customers who, when the interest rate was at 2-3%, for whatever reason, they didn't come in. And so I think the OCC and the collaboration with Operational Reach has been really helpful as we are engaging in some of these challenges, having access to some of the nonprofit partners who are on the call to say, can you help us reach some of these, or can you help educate about the program that we're doing and how to get customers in? And so we're working our way through it, but I think there is a real opportunity. I mean, you talked about the no action letter from the CFPB. There is more opportunities. I mean, we've got an ATR QM opportunity or challenge as we think about moving this now to our next phase, which would be GSE loans. You don't want a customer to have the experience that Lot talked about, which is getting a denial. So we're soliciting them to come in, and if they get a denial, so how do we have a streamlined process? We have that with FHA Streamline, and that process has been working well so far. But as we look to the GSE, which certainly is a much larger population and has more significant numbers to really make a difference, how do we start to challenge, kind of the ATR and QM rules that will allow us to do a GSE streamline? So we'll be calling Sandra and talking to the GSEs about how do we really partner with the CFPB to really drive some challenges and opportunities there to really move and pave the way for lenders to be able to do this. But we are launched, and I think there's more learnings. But my message to the audience is it's safe to get in the water. So come join us, because the more of us that are wading into this space of special purpose credit programs, obviously the more people that we can help and the bigger impact that we can make for these communities.
That's great. That's great news. Yeah. Eric, could you tell us about some of the Chase programs addressing the needs of minority borrowers?
Sure. Thank you, Barry, and thank you for having me. So Chase launched a $30 billion commitment to racial equity. And as part of that, we created a special purpose credit program focused on Black and Hispanic customer bases. It's based in two components right now. We launched it in January of 2021, so we've been doing it about 18 months. The first piece is a $5,000 grant focused on 6,700 Black census tracts in the U.S. The second component is in our correspondent channel where we buy loans from others. We offer improved pricing and reduced fees for customers currently providing access in underserved communities, and we offer liquidity and funding in those communities through the acquisitions of loans. The other piece is, as Director Thompson noted, the last couple of years we've been offering $2,500 closing cost on our DreamMaker refi product. One of the structural issues is for lower size loans, sometimes the closing costs exceed the benefit. By offering a $2,500 credit, we're able to make that refinance more economically viable to low to moderate income customers. We also offer a $2,500 purchase grant in low to moderate income communities, and we've also expanded access to credit by expanding our credit box over the last few years. And with all that, we do that in a very balanced and disciplined way, making sure both the access is there, but it's sustainable. And that's what one of the works of the League for Product Reach is the sustainability piece. We have to ensure when we place customers into mortgages and they have a life event that triggers affordability, we have a set of solutions that allow the customer to preserve their home ownership and make sure the gains we have are sustainable gains through economic cycles. And as piece of that, the secondary piece of the reason sustainability is so critical is when you avoid losses for investors, the pricing can improve. So there's two primarily challenges that we face with providing access to credit. One is down payment, and the second is affordability. The more work we can do to avoid significant losses associated with lending, the more we can improve the pricing for consumers and lower that debt to income ratio. So it's something we're really focused on as well.
Yeah, that's great. So, I mean, as Eric talked about, the sustainability and how important that is, we all know real estate is local, and we haven't talked yet about REACH and the local community. So Barry, I'm wondering if you can share with the group kind of what's happening at the local level with REACH.
Yeah, that's great, and thanks for raising that, Christy. So about a year and a half ago, we launched our first local REACH in Los Angeles. Los Angeles REACH has, yay, there's the Los Angeles contingent has arrived. So we have an affordable housing work stream there. We have a small business, a minority depository institutions work stream there as well. The one I've been most involved in is the affordable homeownership. And I will say the one really important thing that has come out of that has been elevated to the national level is the accessory dwelling unit proposal that has been surfaced, many thanks to a work group led by one of your colleagues at Wells Fargo, as well as Dottie Shebek, who I think is here in the audience. So many thanks to that group. What is important about the work in Los Angeles REACH on accessory dwelling units is that it really is a model for the rest of the country. The state of California probably has statewide the worst affordable housing problem in the nation, and a part of it is a rental problem. So you're really killing two birds with one stone by being able to come up with adjustments and regulatory changes if needed to allow a home buyer to convert part of the home for rental, or to build a accessory unit in the backyard or in the basement or somewhere else on site. And that both helps affordability to the borrower to be able to afford the mortgage, and it creates a rental unit at the same time. So state of California has passed certain regulations that make it easier for local jurisdictions to allow for accessory dwelling units in their communities. And now really it's a matter of the financing infrastructure that we have in our country, including the GSEs and FHA, to adjust their policies to allow a borrower to count some portion of that future income from that rental unit to help qualify them for the home. And so, there's a lot of details that I've been working on through FHFA, through the Federal Housing Administration and HUD, as well as the CFPB, to try to thread that needle so that we can expand the financing that's available for this type of housing. So that's the LA REACH. We have two other REACH initiatives that just launched within the last few months, a DC REACH, and a Milwaukee REACH, and a Dallas REACH, and a Detroit REACH. All of those have a homeownership component to them, with the REACH effort in Milwaukee and Detroit particularly focused on a need, which we've heard nationwide through our project REACH, is a need for rehab financing. Yeah. That these are markets that have older housing stock. We have a huge problem in terms of accessibility of the housing stock in this country to people at the lower end of the affordability scale, but they may not have the ability to get rehab financing, or even the support they might need from a housing counseling agency to do what needs to be done to rehab the property. And in fact, there's also a role for housing counseling agencies with the accessory dwelling units in preparing people to be a landlord. If you're a first-time buyer and you also have a rental unit, that may be an educational challenge that you need help overcoming in terms of how to be a landlord. And so there's been a lot of discussion about the role housing counseling agencies can play there. So the local REACH efforts are getting up and going in the last few cities I mentioned, and we hope that in the not too distant future we can launch a pilot in Los Angeles where we have lenders providing financing for accessory dwelling units along the lines of the pilot proposal that's been discussed.
That's great.
Yeah.
Thank you. Well, I want to go back to, we should clap for that for sure. So I'll go back to Eric and then Jason. I'd love to get you in the conversation because both of you have been workstream leads since the beginning of REACH. And so as we enter now this, kind of third year, would love your perspective on what's working well and then where do we need to go kind of this next year, taking it to the next level.
Sure. So I think there's been a tremendous amount of collaboration across this group, and we need all the diversity of the team and their perspectives and their unique experiences to bring together holistic solutions to just these very large challenges we're facing. I think if we can get the regulation, the product, the policy, the stakeholders all working together to solve this problem and quickly react to, as new information comes, we react to it, I think it'll be very, very successful. I think the biggest opportunity we have is just to be a little bit more action-based. I think we've done a lot of great work, and we've got to continue to drive forward as quickly as possible, making sure we're balancing the risk and reward trade-offs.
So from my point of view, one of the best things that's come of REACH is helping lenders respond to regulatory change. We've talked about it with SPCPs. We saw a great example of it with HPII and the RESPA concerns. I think when we left the meeting with the CFPB, I think most lenders felt better than not, even though we didn't have the no action letter process to rely on. We have much clearer ground rules on how to move that pilot forward. And that pilot has the opportunity to provide a ton of tangible benefit to borrowers. We want to keep denied borrowers engaged because more than likely they're very close. They're on the cusp of homeownership. And so providing that mediating ground for navigating the regulatory regimes is critical. The other item I would mention is that in the context of appraisal bias, we're going to come into an environment where there are going to be a number of stakeholders in the industry trying to all accomplish similar things. If we can get REACH plugged in proactively into those efforts, or REACH can be the hosting ground for those efforts, depending on the amount of leadership needed, depending on the maturity of the effort, I think that can only help to accelerate efforts. Ultimately, when you're involved in work streams like this, allyship is important because you always need more experts at the table. It's rejuvenating when you find people that are working on the same thing as you. And if you can bring more people to bear on a certain issue, then that's more likely to drive action. And action is what really keeps efforts like this alive. Conversations cause efforts like this to fizzle with work group fatigue and all those other types of things. But if we're driving action, then that will be REACH as a catalyst for change, which is what we all want.
Yeah, that's great.
Well,
Let's close this out.
yeah, I want to thank all of you for your very significant efforts over the past 2 years. Let's give them a round of applause. Hopefully this has given you a window into what we've been doing, and I would just make a pitch for any one that is in the room that is interested in joining the Affordable Homeownership Workstream to find Christy or myself later today. Give us your business card, send us an email. We want you part of the effort. It's going to be a team effort, as all of our colleagues here have said today. So thank you, and we look forward to great work in the year ahead.
Our next panel is focused on building opportunities for entrepreneurship and small businesses. Joining me this afternoon is Ramit Arora from Biz2Credit, Marissa Calderon from the National Community Reinvestment Coalition, Mary Michelton from US Bank, and Randy Zeller from Mocafy. Our focus, I'm sorry, and Javon Sterling from Amegy Bank. Pardon me, Javon. So our focus this afternoon is really to talk about some of the challenges that are facing small businesses, particularly those from entrepreneurs in economically disadvantaged communities. One of the big things that we heard about earlier was, hey, there's the appraisal disparity. That's a challenge for a lot of people to get the full valuation of their homes. A lot of times that also leads to limitations and a barrier for people to get the type of collateral that they'll need, or the true amount of collateral that they'll need to start or pursue their entrepreneurial endeavors. There's a lot going on right now in the small business space. We just saw that there's a deadline for the 1071 rulemaking for March 2023. So we're going to start seeing new data and new information come in about who's getting the access to capital and credit for small business and entrepreneurship. We also understand that, as far as collateralization, that's the key access point for individuals who can use that type of resource so that they can get the type of capital to help support and finance their entrepreneur opportunities. In addition to that, we also see that there's a need for technical assistance and individuals and borrowers to understand what's needed for how you can then establish a business credit profile. These are individuals who are typically using their personal consumer profile to pursue these types of opportunities, and that leads to individuals becoming what we consider business credit invisible. So this panel here today, there's a lot of work that's been going on within the small business work stream, and I wanted them to be here to talk a little bit and highlight what they've been doing and how we can move forward collectively to help with bringing in more opportunities for individuals from communities of color as well as other economically disadvantaged communities. So as I kick us off, my first question, as you reflect on the challenges faced by small businesses over the last 2 years, what is your perspective on the greatest opportunities to support the preservation and growth of these types of businesses? So I'll start it off with Marissa.
Well, thanks for having me. Yeah, I guess I think of it, coming out of PPP lending, because we were a PPP lender, that there are some sort of fundamental educational gaps that small business owners have in terms of how to access capital. I talk about proximity to capital being an issue as opposed to actual access to credit, and so understanding how to get access to capital is a challenge, and in some of the technical assistance offerings that we have, whether they're individualized or at scale, that's certainly something that we address, as well as from an educational perspective, just how to actually operate a successful business, how to do that in a way that demonstrates that your business is profitable. Those sorts of business fundamentals we see at our CDFI as consistent areas of opportunity for small businesses, and that's part of what led to the couple of different scalable TA programs that we have that really address common areas of issues that are unique to startups along that path that we have, as well as programs that are unique to existing businesses that are trying to scale.
Thanks. Randy?
Yeah, so I've got one that's kind of on topic and a little one that's really on the next topic. I mean, the on topic is, my immediate emotional or thoughtful reaction when I heard the question was, we got to change the way underwriting's done. We got to change the way credit scoring's done. We got to have more open banking assessment, particularly of small businesses. And if I think ahead to what might change the game entirely, I think it's that. And so I know that's the next panel, but I couldn't answer that question honestly without responding. But the second one is, I agree with Marissa. I think all kinds of technical assistance is needed, and we'll be getting to that as we speak further about the white paper and the things we've been exploring. But small businesses need help, and in particular, a Federal Reserve study of the California Rebuilding Fund just concluded that technical assistance can be critically important in helping small businesses get access to capital. Thanks.
Mary?
Well, I'll pick up right where Randy left off, actually, and I think I can connect their two comments. So I participated in a working session with a local coalition in Minneapolis, where I'm based, just yesterday, and there were two insights that came out of that. One, Marissa, you mentioned the PPP program. So we had these fantastic recovery programs in 2020 and going into 2021. And although those have not continued, COVID does continue and continues to be a challenge. And so perspective I heard directly from some business owners was that we can't rely on one-time solutions. We really have to build sustainable financing solutions. And the other insight that I heard expressed by business owners within this coalition was, we're over-mentored and underfunded. And and so as we talk about technical assistance, I think what's really important, I don't want to diminish the need for technical assistance. I think that's real, but if it's not delivered in conjunction with funding of some kind, and making sure that it really leads to access to capital,
it's just going to create that kind of frustration of like, you can mentor me all day long, but how are you going to help me actually access capital? So I think that's really important and actually speaks to a couple of the key themes of what we've all been working on around technical assistance and special purpose credit programs. So we'll get to that, but I'll stop there for now.
Thanks. Robert?
No, I would say basically hopping on to what Mary said, that cash flow based lending becomes very important in this environment because you have businesses that have been around only for 3 months or 6 months, and what we have seen is that these are immigrant owned businesses or located in a low moderate income neighborhood, and they need help, and they would never qualify for a bank financing because they're probably not going to show profit on their tax returns. So that is where cash flow lending and technology led lending becomes very important. And we have been able to fund businesses who have been around for 3, 6 months, 9 months, because most businesses don't even qualify for financing until they've been around for 2 years. And I think that is where banks and fintechs need to work together, where if someone like Bisto Credit is funding those customers, how can we then graduate them to a bank loan after the first 2 years or 3 years of existence? And the other opportunity I see is that how can we expand the scope of the CRA programs, where banks are able to work closely with companies like ours to fund these minority-owned businesses, fund the economically disadvantaged businesses. And the third, like we have just come out with a new innovative product where we are helping fund companies with an interest-only loan when they're waiting for their employee retention tax credit. Because a lot of businesses are suffering after not getting, like PPP is done and over with, their loans have been forgiven, and now they're looking to survive because inflation, supply chain crisis, there are a lot of issues still with COVID in certain segments. So what do businesses do? So they're now waiting for their ERTC funds, which are delayed by 12, 15, 18 months. And that is where we have come up with a new interest-only program. We have worked with debt buyers and investors on our platform to earmark about $200 million for small businesses across the country to help them with alleviate the stress that they're facing right now.
Thanks. Javon?
It was great to be here, and the best part of following my colleagues is I can say everything they just said is correct. But I want to add, I want to lean in on, I think what I believe is an opportunity is for the financial services industry to continue to invest in their social responsibility. I think there are two parts to this equation. There's personal responsibility, which they talked about, the need for technical assistance, but at some point, at least the frustration if it doesn't result in access to capital. So let's talk about what I think is the social responsibility of the financial services industry. We take every dollar of deposit of everyone here, we keep 10%, we lend 90 cents, and we make a spread. So we are really public servants, and we have a responsibility to ensure that the system works for everyone. And recognizing that also not everyone is on the same playing field due to a number of factors, right? And I think that there's an opportunity for us to really gain consensus around what are the common reasons why small businesses don't get consistent access to capital, and then use that as a call to action to create innovative programs that can start to really level the playing field, such as the type of programs that we've done here. Another point I'll make is that there's an opportunity for really addressing the fragmentation that I believe exists within our industry, and specifically around the information. If business owners have no more time than the man on the moon, really what you need to point them to is the bullseye. You need to point them to where to go, and it needs to be effective. And so the proof is in the execution. And so all the resource partners that are involved, all not-for-profit organizations, the educational institution, all the advocacy groups that are providing financial education really need to consolidate that into a single point of access where a business owner can access that information and use it effectively. So I'm excited to be here and to talk a little bit more about what we're doing.
Thanks, Javon. Javon, staying with you, we often hear about technical assistance. I'm going to save Mary for last because she already has talked about we're over technical assisting. But what are your thoughts about technical assistance and how this is really critical to the support of small businesses?
I'm going to use the opportunity here to attempt to change the term technical assistance and really talk about business support services, because the notion that technical assistance is necessary by for disadvantaged communities is inherently not recognizing that there's a gap in access to that information. So business support services, in my opinion, is a more inclusive term. So what does that mean? It means that the institutions, there exists just an incredible universe of information. Nowhere in the world can you get information, free information on how to start a business, how to run a business, how to scale it. So then is it the availability of the information, or is it the application of the information? And also, how does that translate to true capital, which is revenue and profits, right? So I view this as being more of a term that we talk about business support services, and what are those services that are necessary to allow businesses to scale from a solopreneur to a company that could become a Fortune 500 company.
Rob? So I would say again, education is very important, giving the resources to small business owners, because I would say there's a huge information gap for minority businesses and economically disadvantaged businesses, that they don't know where to start, and then how to access capital, where to go for that. And then if you provide them online tools and technology, what we have seen is that about 60% of our minority business owner applicants would apply for business financing outside of the normal business hours, because they're reading that information. We're providing them with a lot of tools, and then we are basically giving them information on if they're acquiring a new business, or acquiring an existing business, pointing them out to SBA programs, pointing them out to special acquisition funding programs we have for them, because that becomes very important in terms of helping a new business get off the ground.
Marissa?
Yeah, well, I think of it, our approach is really about finding a way to get to yes. So we begin with that in mind, and we know that every business owner that comes to us isn't ready yet, but because we begin with yes, then that's sort of how we approach our two different academies that I mentioned, and I agree with you that business support services is a more inclusive term, because small business owners don't know what technical assistance is. That sounds like something that it's not for them. So we drop the industry speak, and we speak to them in terms that they use. We meet them where they are, and so our the content that we work with for them really addresses the most common issues that we see, whether they are startups or existing businesses. So they don't need everything under the sun. We don't need to boil the ocean. We really only address the specific gaps that we see that are common, that are speed bumps to getting them financed. But I would say that as or more important in that process is the actual social capital deficit that minority entrepreneurs and women entrepreneurs face. And that's what we choose to address very intentionally by building a cohort system within where we work with entrepreneurs, and then that just becomes progressive. So every single cohort builds so that they actually have an intentional network that they can dip into, as opposed to feeling like they are a person on an island that doesn't necessarily know what door to open or how to access proper funding in the middle of the night, because they're also working at a job trying to figure out how to start their startup.
Thank you. Randy?
Yeah, so what Mocafy is trying to do incorporates a lot of the principles that are in the white paper that we'll be publishing. But we start with the idea that you got to reach people, and you got to find a way to find them. And so Mocafy is creating a digital small business banking product. Great, lots of people have banking products. But what we did is we kind of tether onto that the things that we think a small business needs to actually get to the point where they can access capital. So we have curated, we've gone through and done some curation of sources of financial education and tools that are best suited to small business owners. We have also are curating sources of technical assistance, which is something I hope we can do in a really big way as part of Project Reach. And then last, just to build on the point that I think several of you made, one of the things we're also going to be doing is curating referral to sources of affordable capital. And I focus on the word affordable because I think that's an important part of how we can help the small business owner.
Thanks. Mary?
Yeah, so at US Bank, we've been piloting a program that we call Access Business, which is focused on helping minority and women business owners. We've started with a focus on Black business owners, and we actually created a role called the Business Access Advisor, which we've hired in 9 markets. And we've really tasked that person. They are a banker, but they're not a traditional banker with traditional production goals. We're asking them to address what we view as the 3 key gaps for minority business owners. Access to capital, obviously, is one of them. Access to education, that's where the technical assistance comes in. But to Marissa's point about social capital, access to networks. And so originally when we created this role, we envisioned it as being 100% working with business owners and connecting them with all of the resources, whether delivered directly by us as a bank or through nonprofit partners or through CDFIs, depending on what the needs of that business are. Interestingly, what we found is that there was really strong demand from within the markets, all the other bankers in the markets, to understand how they could play a role in closing some of these gaps. And so we're pivoting to where these business access advisors are spending close to half their time equipping the rest of the market with the knowledge and resources that they need. And so we do leverage some technical assistance programs like the one that the FDIC created, Money Smart for Business. But each of the BAAs, the Business Access Advisors, really does a lot of work to just understand all of the players within their local ecosystem, because it really can vary locally, and work closely with those partners so that where appropriate, they can introduce a partner to provide further networking or technical assistance, or if we're unable to underwrite a loan, introduce them to a CDFI. So we're really trying to take that kind of holistic approach. So going back to the earlier point, I don't by any means want to suggest that technical assistance isn't a need or isn't valuable, but it's really about pairing it with all of the other supports that are needed to drive success.
Yeah, I think Javon hit it on the head. It's the business resources that are needed. So you mentioned a little bit about the white paper. Randy, you talk a little bit more about that?
Sure. So it's interesting when we listened to the group prior to us, because I was thinking, wow, they're actually doing things already. And I was feeling, and we're about to get to that. But what we've done is spent the time thinking very holistically and I think broadly about how technical assistance can actually help small business owners. So Andrew gave us a challenge. We started with, what are the common reasons for turndowns? Could technical assistance have helped that small business owner avert the turndown? If so, what kind? And even if it couldn't have averted the turndown, recognizing that not every business is ready for loans, would technical assistance help that small business owner get to yes more quickly? And so we thought broadly, as I said, about that. We've come up with 4 ideas that we recommend exploring. And there's actually more in the white paper, but the highest level ones have to do with, first, financial education and curation of financial education. There's so much out there, and we want to make sure that the financial education available gets to people the right kind in a culturally appropriate way. Second is curation of technical assistance. Again, there's lots of different providers out there. We want to make sure that perhaps to the extent possible, while there aren't current standards, but to the extent there's standards and data about effectiveness, we're picking the ones that are the most effective. And then second, and as importantly, we want to create a directory that organizes technical assistance providers by geography and expertise and kind of industry and the things that will help the business owner get to the place that is most helpful to them. Third, and I think others on the panel can speak more about technology than perhaps we can, but we think there's a couple of different ways that technology can help. And one of them is going to be in identifying and just getting the information to people. And I'll stop there on technology since the business, Ramit is going to be more qualified than I am on that. But then last, we want to make it happen. We don't want this to be kind of an interesting white paper that sits on the shelf, and we are very much with the first panel. And to that, we're forming an implementing group. Several of the bank members and other members and people on the stage have all committed to a working group. This idea came from Tim Welch, who is on the National Advisory Committee, and said, look, we just formed an MDI in Minneapolis. Let's get a group of our stakeholders together and let's get to work for 18 months. Let's each put resources against it and let's figure out how to make this happen. And so we're now at the point, we hope the white paper will be published in the coming weeks and will be available to all of you. And then we're now ready to make it happen.
Nice. Mary, Marissa, you want to add anything to that or any thoughts?
I mean, I think some of what's, much of the white paper, it's great stuff. Some of what's interesting is really, I think the intentional pairing of education and then the conversation around social capital and the need to really address both. I mean, I feel like this is, something that I really want to hammer home because there's a lot of education out there, as Randy mentioned, and some of it's good, some of it's, it is what it is. But really what there's a lack of is intentional programming that addresses the social capital deficit and the need to actually make sure that there are existing, thriving, functioning, productive networks that folks have access to as a means of helping to grow their business.
I think all I would add is just two things that I view as the critical hurdles or challenges for us to overcome. One, to Randy's point, you mentioned Tim Welch. I report up into Tim, and he's an inspiring leader and a good example of the kind of collaboration that he was suggesting that we all engage in. All of you have probably been part of collaborative efforts that ultimately don't deliver very much because we like to talk to each other a lot. So I think we all just have to really challenge ourselves to commit to action. And we heard that from the director this morning and from others. So I don't think that can be emphasized enough. We had a working session this morning with several of the folks on the stage, plus a few others, to really focus on how do we take this to next steps. And we were talking about getting committed players, and Javon said, well, we're all sitting here, so we're committed. So we've got a good start there. The other is, and Randy alluded to this too, but is just making sure that whatever resources we put together really get utilized. This directory of technical assistance being one example, it's all well and good, but only if we find ways and channels to get the word out and really point business owners there so that they know it's there and can use it as a resource. So I think it's going to be important as we develop that to build, metrics and KPIs where we're really focused on use of the platform and not just its existence.
Thanks. So, Ramit, technology is always one of the key aspects of what's needed for small businesses. Could you talk about what you see as a role for technology firms in the small business financing ecosystem and what your firm is doing to create the opportunity for small business owners from economically disadvantaged communities?
Sure. So, when we started the business, my brother and I, we focused, like the first market segment we picked was Queens, New York, and we saw a lot of immigrant-owned businesses. A lot of them were South Asians, and Hispanic businesses. And one of the common underlying factor or themes that we found was they were very intimidated to face a business banker, to go and walk into a branch and present their application. And this was in 2008, and there's no technology at that time. And then one of the things we asked them, what is the solution? They said, if there's a technology solution or a platform where we can go in, we can enter our application and our information, then we don't have to face a business banker, because they were worried if their business would look good, would a business banker report them for hiding taxes or not paying all the taxes, and are they doing the right thing? And so that is where now in the evolution of our business, when we have done about $8 billion in financing over the last 14 years, what we have seen is that, as I mentioned earlier, that 61% of the business owners, minority business owners, would apply after hours or over the weekend. And I would say most of the business owners, 55% of them would complete an application across the board on a mobile device, whether it's their phone or tablet. And one of the other things that we are seeing is that people are now accepting technology. They're not as worried about sharing information. A lot of lending or financing we do is cash flow based, so they're very open to sharing syncing their bank accounts onto a platform using technologies like Yodlee or Plaid. And I would say, especially in Black-owned businesses, 67% of them are willing to even sync all their bank accounts for the last 6 to 12 months. So technology, I would say, is a great leveler. It enables access to opportunity for a lot of minority businesses and economically disadvantaged businesses. They can apply at their own pace, at their own time, without having to face anyone. And then they can be presented with a lot of options through a platform where they can see if they qualify for alternative financing or they qualify for SBA loans or bank financing. So I would say that is giving them an opportunity to see what their business could qualify for without this being an intrusive process. And we are now giving out our technology to the banks as well. So we have this part of the business called Biz2X, which we started in 2018, where now about 50 banks are using our platform to digitize their offerings for business lending, right from origination to underwriting. Because one of the biggest problems that banks face right now is that underwriting takes about 3 to 4 weeks, or at least 2 weeks. And with our platform, they can cut down that time to about 24 to 48 hours. Because we are pulling all the data sources in one place, giving them access to their cash flow data, their income tax data. So all of that just enables both the lenders as well as the borrowers to sort of harmonize and make small business lending more efficient.
If I can add something, it's a great point. There are two parts. So there's the small business owner and how technology is helping the small business owner. And then there's the lenders and importantly, the technical assistance provider. So what Ramit just spoke about is the importance of technology to streamline the entire process, and I agree with that. But there are also lots of firms out there working on technology to help the technical assistance or business support services provider, I'd rather say, provide more help. And so instead of spending, as I understand it, something like 80% of the time diagnosing and 20% helping, they can, if they have the right technology to help diagnose using things like open banking, then they can spend 20% of the time diagnosing and 80% helping. And that would be the goal.
Yeah. Mary Javon, just from a business or from a financial institution perspective, what do you see as far as like technology that could help you with creating more opportunities or facilitating more facilities or vehicles for?
So I think the market is segmented among different consumers or businesses who want different levels of access to the bank. There's still a segment of the market that values the relationship. And when I meet with business owners, I ask a simple question: how many have a family doctor or a family insurance provider? And half the room will raise their hand. I say, how many have a family banker? And nobody raises their hand. So the notion that a relationship can exist with a bank is not one that's shared by many communities. And so that we saw play out in PPP. The businesses that were successful in navigating that PPP process had relationships, that they knew someone, which goes back to Marissa's point about social capital. Social capital is very rich, and within it, that comes the banking relationship. That said, the relationship has to be enhanced by the technology, and that's a challenge for the entire industry. AI and blockchain and all this emerging technology has a place within our industry, in my opinion, to augment the customer experience. So we are, the banking industry spent about a decade reemerging from the housing crisis, and so the amount of investment that's being made right now in technology is about 20% of overall revenue. So it's not an insignificant effort on our part, but there's still a significant gap between what a company like Business Credit does and what most traditional banks will be able to do. And so recognizing that gap exists, we're leaning into the investment.
I think I would pick right up on that point in terms of leaning into the investment, because U.S. Bank has invested heavily in our digital capabilities to support small businesses. So we do have a digital platform for applying for credit for small businesses, and we've extended loans in minutes in some cases. I think there are still some opportunities, not only for us but across the industry, to go even further along the lines of what Rama was talking about, with use of different types of data and different ways of evidencing, ability to repay. We've also invested in our digital platform beyond accessing capital to just providing the capability for a small business to access everything about their relationship with the bank and beyond, accessing relevant partners and things like that to really help them manage their business.
No, and one more thing we have done, and sorry to just interject, but is that we have partnered with the AI CPA. So we have brought on like 5,000 CPAs onto our platform, and that worked out really well during the PPP program, where they were able to complete packages for their customers. And I would say that also helps in fulfilling part of the technical assistance part of the business as well, because CPAs are very closely aligned with the business owners. And so if you can digitize the CPAs, we have created something called the CPA loan portal. So then you're solving a lot of the problems that exist in the last mile, where business owners depend on their CPAs for access to financial documents. So if you can get them online, then a lot of the access to financing becomes much easier.
If I could just add from a CDFI perspective, there's a digital divide in the lending space, and CDFIs are on like the divided side. So it's an area that is resource constrained, that is incredibly analog. So you have providers that already have the relationships that you need to be able to meet borrowers where they are, but are hamstrung in many cases by a lack of access to tools and technology. And I would say that for us and for those CDFIs that participated as PPP lenders, the differentiating point was the fact that we did have technology and that we were mobile first, because that's exactly how our Black, Latino, and immigrant small business owners operate. They use their phone as their computer. Yeah. So please don't ask them to fax you anything, and don't ask them to wet sign something and send it back to you. And today, being able to leverage those sorts of investments that other folks are making to enable CDFIs to be high tech and high touch would really make all the difference.
All right. So we've heard a lot of talk earlier today about special purpose credit programs. And I know that we've heard about some of the developments in the homeownership space, but there have been quite a few in the small business space. Javon, I know your institution has instituted one, and I'm sure a lot of people would like to hear a lot more about how and what it took to put that in place. So can you talk a little bit about what you're doing?
Absolutely. In May of 2021, Zions Bank Corporation implemented the Small Business Diversity Banking Program, which is a special purpose credit program under compliance with the Equal Credit Opportunity Act. Since 1974, banks have been permitted to collect racially identifying information, but due to a variety of reasons these programs have not permeated the small business space. There's a lot of dialogue within our organization for over a decade now about how do we serve diverse communities, and we had an opportunity to meet with the OCC and the CFPB to really better understand the creation and how a regulator would look at a program that may take on a little bit more risk. And I'll get to that in a moment, because that's a very important point. So we met with the regulatory community. We knew we needed their guidance on this topic. And then we invested in a task force of representatives from all the Zions Bank affiliates. And we accomplished over 200 workforce tasks and stood up the second, to my knowledge, second special purpose credit program for small businesses in the country. And fast forward, where are we now? A year later, we have visibility that we'd never had before. It's almost like we have night vision. We're able to see things that we weren't able to see before because we weren't able to collect that information. At first, we didn't go to the regulators with our own experience information because we didn't have it. We weren't collecting it. A year later, we can tell you that the notion that you're increasing risk is not necessarily founded. At least a year later, 96% of the people who are eligible small businesses are those who self-certify that they belong to one of underrepresented groups: women, minority, veterans, and LGBTQ+. So when they self-certify, what we're finding that they may not need a credit enhancement. 96% of those are not needing the credit enhancement. So it tells you that they're meeting your credit requirements, right? So there's an opportunity there. Only about 6% of the applicants really need the credit enhancement. So we're learning a lot. We did not know before just how many loans we were making to these communities. Now we know we've made $250 million in loans to these communities. Now we know exactly the number of applicants. We know the composition of it. That's data that we didn't have before. So that information is basically helping us to create a path forward where we're going to continue to refine our model and go to the market. What it tells us is that more people need to know about what we do. And the notion that you need a special purpose credit program just to access the minority community is I think, partially correct, but also that community needs all the bank services, not just a special purpose credit program. They need consumer lending. They need small business lending. They need SBA lending. They need to be referred to technical assistance or business support services. They need access to revenue. They need not only to rely upon the supplier diversity programs, they need mentorship. They need to be given the opportunities to have dinner table conversation that results in deals the way everybody else has opportunities. So I do think that this is a step in the right direction. We're doing something. It allowed us to learn a lot more about the population that we didn't know before. But now we're saying we need to offer more than just a special purpose credit program. We need to offer a relationship.
Yeah. Javon, can you tell us a little bit about just some of the steps you had to take as far as standing up that program internally?
Well, we had to get our regulatory partners on board, and then we next had to get our compliance partners on board. Start with the end in mind, right? And we literally went to them last. But we had to develop something that we all collectively thought could work. We went to our underwriters. We identified the common decline reasons, and we looked at our credit policy, and we said, okay, we have a credit elsewhere question that we're a top SBA lender, so how can we offer another conventional program where we're taking the risk, not asking the SBA to guarantee it, where we're taking the risk, but how do we navigate credit elsewhere? So we had that discussion. We got our credit administration support team to support an expanded policy so we have two conventional policies. One that's specifically available to the special purpose credit program eligible participants if they need it. So we didn't want to pigeonhole our applicants into just a special purpose credit program. We said, if you apply and you qualify, keep going conventional. But if you apply and you don't qualify, we have an opportunity to put you into an expanded policy. And from there, if you don't qualify, we're going to offer you SBA. And if you don't qualify there, we're going to provide you with technical a referral to business support services and a CDFI. So all that can be done without the applicant having to reapply. So it's a waterfall. And that waterfall, if done seamlessly, now we're not perfect, we're still working out the bugs, but if done well, right? Someone said a declined client is a motivated client. That is correct. If you put them through a process for 30 days to say no, I think that we haven't done our jobs. We literally need to work collectively with the CDFIs and the business support organizations to show them how to become ready. Not now, later. Not no. Thank you very much. Goodbye. So it's a process.
Thanks. Mary, I know that you're also thinking about establishing some type of special purpose credit program as well. You want to talk a little bit about what U.S. Bank is doing?
Yeah, so we don't have a program in place today, but we've made a commitment within our recently announced community benefit plan associated with our intended acquisition of Union Bank, and that is all subject to regulatory approval and subsequent closure of the acquisition, but we have announced our intent to adopt, enhance, and expand the special purpose program that Union Bank developed, I believe, about 30 years ago. They have one of the longest, if not the longest, standing program for small businesses in the country. So we're in the process of planning for that integration, and in so doing, essentially, it looks a lot like the steps that you would follow to establish a new program, because we wanted to go through the diligence of compiling the research that demonstrates the need for the communities that we want to serve, and looking at how that will live specifically within our credit policies, and we'll go through the process of reviewing it with our regulators and so forth as well. So work in progress.
I know. Well, I know that we have a few other things that we're also developing within this work stream that we didn't have a chance to present today, and that is not just focusing on the balance sheet side of small businesses, but also on the income side, the income statement side. And what we're working with several of these different financial institutions and providers, service providers, is how do you increase supplier diversification for the small businesses and minority businesses that need to create that type of relationship or some type of revenue stream to help them to be viable and to keep them moving and also growing and expanding. And then the last thing that we're focused on, which you'll hear a little bit about in the next panel, is looking at alternative data in the small business underwriting spectrum. Of course, initially, most of this is going to develop or focus on some of the consumers that we see or consider credit invisible, but I think that's something that's going to be very key as far as how we can then expand these types of opportunities, especially once we start seeing the collection of data that will help us to understand who is the minority borrower or who is the actual economically disadvantaged customer or consumer who needs this type of access. Final thing, closing out, what else should we consider for increasing access to capital and credit for small businesses from economically disadvantaged communities? Starting off with the ladies. So Mary, I'll start with you.
Well, I don't want to let the opportunity pass to highlight one of the other pieces of work that we're looking at within the working group for REACH, and it's within this realm of special purpose credit. So there are very few programs actually in the country, special purpose credit programs that are dedicated to small businesses. So as a group, we determined that we thought the best way that we could make an impact was not just to socialize the programs that exist, but to encourage and enable more lenders to develop those programs. And so what we're planning to put together is an online resource hub that demystifies special purpose credit, if you will, and really lays out step by step what does it take to put a plan together and take it to market, and collecting resources that many banks could use to help, particularly in the part of the plan that you have to demonstrate the need. There's a lot of publicly available research that we think there will be value in bringing together for anyone to access, so that you don't have multiple lenders having to go dig it out independently. And so, consistent with my comments earlier about the technical assistance platform that we were talking about, what will be really key there is making sure that we get get the word out and really make sure that that is used to the service of lenders developing these programs. So that's a big opportunity, I think, for the industry overall.
I think the roadmap is going to be a big help and assistance for a lot of these institutions. We heard Christy earlier talking about come on in, dip your toe, and I know Javon, you want some others to dip their toe in as well. So I think this will help a lot of borrowers who need this type of support.
Mm-hmm.
Randy, your thoughts?
Yeah, I'll give two. One is a lot more money going to CDFIs to support them in both lending and in infrastructure. They are I think, one of the primary sources of affordable lending in the country. I know about the SBA, but for me, that's a big bucket of what we can do to help. And then the second is we've got to reach the small business owners where they are. And the idea that I love the most, at least of the several that we've been kicking around, is let's make an off-ramp for rejected borrowers and get them to the right sources of technical assistance and let them know about other sources of affordable loans. So.
Marissa?
Yeah, well, I echo the CDFI comment because CDFIs are already in communities working with borrowers and in communities that are historically disinvested. So, more access to capital that's affordable that can help to accomplish mission is really, really important. I think the other thing that I want to lean into is the technology component. That CDFIs are a space that is really ripe for modernization, and with access to partners and technology that is affordable for CDFIs, more needs for more borrowers can be met. And that's sort of a bigger problem than Project Reach can maybe solve, at least immediately, but that's certainly something that needs to be done.
Rob?
So I would say, how do we make, as Marissa said, technology be a great leveler, like how banks, CDFIs, and fintechs like Biz2Credit can work together. And then I think, how do we make cash flow lending more mainstream? Because we have tested it out over the last 8+ years. We have models that now work. We can build financial statements out of their bank statements. So, how can we help small businesses by just looking at their bank statements or cash flow data to give them access to capital? Because I think that will become very important going forward, because just looking at their income statements or tax returns, which are historical, would not solve the problem. And if you have to broaden out the access, then we have to go to the next stage where we see the cash flow based lending models and test them out, and banks and fintechs work closely to expand that.
And Javon?
As I said before, my colleague said it all. So I think it's just a call to action. I think this social consciousness has a shelf life. Many of you will probably agree that a lot has been said about this topic, and not as much has been done. So I think that really the takeaway here is that there's a call to action. It's not as challenging to stand up a special purpose credit program. It's not the only solution for the community, but it gives you unprecedented reporting and access that can help to grow your organization's presence in all the communities. So I thank everybody for being here, and that's all I've got.
Thanks. So I know that you have been sitting here so patiently today, waiting to get engaged. So I want to open it up for a few questions. BJ, do we have a microphone? So if anyone has any questions from the audience, we'll take a couple before we transition to our next panel. Robbie, here comes one right here.
Thanks. First I should say I'm so glad to be your colleague and do this work with you. A few of you mentioned just the idea of financial institutions introducing customers to CDFIs. Marissa, you talked about just the path to yes. I just wonder if there's any more comments there, because it's my opinion, Robbie from Wells Fargo, that a CDFI should spend zero time trying to find small businesses to provide their amazing services to. And I think the financial industry really owes CDFIs that level of support, because then it lets you do so much of the great work you do. So, Marissa, I don't know if maybe you have an answer, but anybody else, please weigh in, and I can share a thought on something we're doing when we're done.
Well, I agree, and I'm open for your referrals. Let's talk. I think the common problem though is how to do that efficiently. And so there's a couple of different platforms. Mary talked about U.S. Bank, and Citi has a platform where there is an intentional connection that's nascent to be able to using technology to make those referrals to CDFIs. But other than in those two instances that are pretty early on, before that, it's like, who do you happen to know at a bank? And you're working at a CDFI, and how can you get like a phone call? And all of that just introduces friction into a process that's already really friction filled. And meanwhile, you have a borrower waiting in the wings for someone to provide them some capital that they maybe are qualified for, which is just more time that borrower doesn't need. So I think that here is sort of another opportunity where intelligently applied technology can help to make that referral process a little simpler. And I would say on the other end, not every CDFI is going to have the capacity to be able to serve the needs of the borrowers that are being referred. So, a sort of vetting process to make sure that you're making a connection with a ready CDFI that has capital and that serves that community, and has the resources to be able to be the right source is important as well.
So I'd like to add that the concern that I've heard from the compliance community is that there's a potential of steering, right? And so how do you navigate? How do you make that referral? Well, I submit that we don't charge a fee for making a referral, right? We're all in this for the benefit of the small business. But then we also provide them with a standardized way to make that referral. And what I've seen is the CDFIs vary in their ability to, or in the features that they provide to facilitate that referral. And if you lose the client in that handoff, right, someone goes away discouraged versus remaining motivated. So I think it's how the financial institutions make that warm handoff. And then finally, most CDFIs, to my knowledge, aren't deposit gathering institutions. So therefore, the traditional banks have the opportunity to maintain that banking relationship, to provide the full service banking services that they need while they're being incubated or assisted at the CDFI level. And then that client can come back, because at some point they've got to turn their capital to maintain the liquidity.
And Javon, I think that's a critical point, and it goes to what I was going to add to the conversation, which is that in addition to the logistical challenges, I think we really have a cultural challenge within a lot of banks. Robbie, I think we maybe have talked about this, and it resonated with you as well, that bankers are very resistant to make referrals because they feel like they're turning the customer away. But what you just said, Javon, is a great way to position that you're not letting go of that relationship. You're facilitating the relationship by helping to meet their needs. But I think that's something that we all can work harder at to really, change that culture and that mindset for folks on the front line.
Yeah, thanks. What we did is we partner with CRF and the Connect to Capital program, which is one to check out if you're unaware of this process. But I just love.
Yeah, we do the same.
Yeah, that's awesome. But I love, Marissa, thank you for validating, because I think there's just a real opportunity for us to do this in a really customer-centric way. And Javon, to your earlier analogy, a doctor refers you to a specialist, right? So if you're the family banker, it's okay to refer someone to a specialist. So thanks for letting me share.
Thanks. Robbie. Hi, my name is Kimberly Kelly-Raw, and I'm the director of the Southern California Virtual Business Center. We're part of Los Angeles Reach, and we're also leading the accelerator for small businesses. So I wanted to speak more toward the technical assistance part. because my background is I was also an accountant for 20 years. And one of the things that I've learned about working with small businesses, because specifically we provide capacity training for diverse suppliers to be able to secure corporate and government contracts. As we work with small businesses, one of the biggest barriers is not only their financials, but it's for them to be able to understand even what that process is for qualifying for capital. So it's just really getting it down to, I like what Levon, I believe, said, was getting it down to the basic level where small businesses truly understand what it takes in order to qualify. And then, as you all spoke about, having that process sort of to, once you do get them in the door, working with them over a period of time to help them understand, this is how you begin to grow into capital, this is how you ultimately begin to qualify for capital. But I don't want the idea of technical assistance to be minimized, because we've been able to successfully help small businesses secure over $100 million in contracts. A lot of times those businesses, they secure contracts, then they need to have an opportunity to be able to secure capital to go along with it. But there's a process. So as you help them to be able to grow in education, especially when it comes to securing capital, getting their businesses in position to qualify for capital, that's where that technical assistance and support comes in to really help those businesses through that process. So my comment today is don't minimize technical assistance, because it's so important, because a lot of businesses aren't even aware, because they're so busy working in their businesses, they don't take the time to understand how to form their relationships with businesses, what it's going to take in order to meet the requirements of underwriting. So some of those basic things I think are really important. So I wanted to share that today.
So thank you for your comment. I think it's very important. Technical assistance, business support services are very important. It's important to the extent that it does expand access to capital. So when I have an opportunity to speak with business owners, I always encourage them to perform the friend raising before you do the fund raising. Friend raising is analogous to developing a relationship. When you go to a bank and your hair is on fire and you're like, okay, you don't have your statements together, it's very, very challenging, right? No matter how much technical assistance you've been provided, it's very challenging for the banker to get comfortable with the situation. So do the friend raising before the fundraising. I will buy breakfast, I'll buy lunch and dinner, and I will have conversations with you over a period of time to better understand your circumstances. And I think in that relaxed environment, it's easier to impart information. It's easier for me to hear. It's a two-way relationship. So when the application is when it's time to apply for a line of credit, not because you need it next week, is because it's prudent to have a line of credit. You apply for a line of credit when you want it, not absolutely when you need it, right? So if you build a relationship, it allows for the technical assistance to really take root in the fertile ground of the relationship, and then that's when you can actually provide capital.
Nice. Last one, Richard.
Yeah, Javon, I think you got a theme song back there, so congratulations on that. Richard Bynum, PNC Bank. First of all, I just want to congratulate you guys on the thoughtful nature of the work stream. With the white paper, one of the things that I've heard several folks mention is this notion of social capital. And I assume you mean social capital to activate and have access to markets, right, for the business. So is there a part of the white paper that would include the activation of what I would call COIs, or centers of influence, the ecosystem, chambers of commerce that might be important? So part of that ecosystem of a marketplace that gives the social capital for access to markets.
Yeah, so the thing that we mentioned specifically in the white paper is the Operation Hope 1 Million Black Businesses that is making a concerted effort to not only help the businesses get capital, but do so through the formation of networks and social capital. The white paper, I don't think, mentions chambers specifically in the context of social capital, something we can certainly talk more about. But the idea is there. We gave one example. There are many, and we'll consider adding others.
I think it's a great idea as a means of, if nothing else, driving awareness of the resource that we build. So thank you for that. Yeah.
Marissa has a comment about the cohort group
Yeah, well, I mean, that's really why we built our programming in a cohort base. It was as much about creating networks amongst each other, as well as, especially for the businesses that are established and are looking to scale, helping those businesses scale by introducing them to the idea of centers of influence. So Stanford's Latino Entrepreneurship Initiative does an annual report called the State of Latino Entrepreneurship, and their research shows, and this is also true for Black businesses, that networked businesses are more likely to be scaled businesses, and it's because of what you just mentioned. So, I mean, it's incredibly, incredibly important in being able to understand how to be able to access resources that are, just a known commodity and available to communities that are not historically disinvested communities.
Yeah, it occurs to me also that technology could play a huge role pretty quickly in that space.
Yep, agreed.
All right, thank you. Thank you all. Please join me in congratulating this panel. All right, so now our headliner panel, which is for how we can explore ways to support the credit invisible population. And this will be moderated by our Senior Deputy Comptroller, Gravetta Gardner.
All right, so thank you guys. All right, you guys have been patient, you're hanging in there. This is the 7th inning stretch, so here we go. So I really want to thank everybody for coming out today to hear all of the Project Reach work streams and all of the work we've done. There's a recurring theme here I think you've probably picked up on, which is this unique opportunity that we've found, and our role as convener to bring a broad group of stakeholders together who may not have been packaged as well as we have been for the past couple of years, all in what I like to call the Hollywood squares of Zoom calls. But we've created some real synergies across all of the work streams. This one may be one that you've actually heard a little bit about, though. Maybe more so, because we've hit some news cycles and we've had a lot of good information, sometimes a little misinformation. And what I really want to spend some time together with this esteemed panel this afternoon is really, getting this problem statement out here. What are credit invisibles? Who are these folks that feel that the system is broken, that they can't participate? Because they can't participate in it, they're not engaged. They're not a part of the financial framework, the safety net that so many of us enjoy. And so I get the esteemed honor to deal with folks who I deal with on a monthly basis anyway. So this panel, and I'm going to start to my immediate right and go right down the line here, is made up of John Pitts, who is a global head of policy at Plaid, Rich Franks, who is our head of Lightbox at Credit Karma, John Hope Bryant, the founder, chairman, and chief executive officer of Operation Hope, Mark Brucker, who is Chief Risk Officer for Consumer and Community Banking at JP Morgan Chase. And last but certainly not least, and our guest of honor and appearance today, Melissa Coity, who is Chief Executive Officer at FinReg Lab. So I want you guys first to give them a round of applause, get them stirred up. Because what we're really going to do today is talk about, explain the how and the why of what this Credit Invisibles work stream is actively working to improve mainstream financial access, credit availability, and consumer financial literacy for credit invisibles and economically disadvantaged individuals in this country. But now, we got to set the stage for you guys, because we've been doing this for 2.5 years, and while everybody knows, you should know what we heard when we first asked Melissa to come and talk to our panel probably 2 years ago now, and set the stage. So Melissa, you and your team at FinReg Lab have done a lot of research, gathered a lot of data.
We do a lot of research.
Yeah, you do. And you've done a lot of analysis, and we follow this.
Right.
But I think it's going to be helpful for you to share with us what you found about credit invisibles, what that need is, and where you think this can go. And that's going to set the foundation for this discussion today.
Sure. Well, it's an absolute pleasure to be with all of you. Thank you for having me, Gravetta, and it's great to be back to talk about some of the work we've done. And I know some of you have heard this in the past, but I think it is really important, especially as we're coming, hopefully, out the other side of COVID, but also with the potential risk of a recession ahead of us, to really make sure that we're thinking about Americans at large, including the up to almost 50 million US adults in this country who lack access to safe and affordable credit. And credit isn't just important because it is a stepping stone, whether it's, how you're paying for transportation to get to the job, or how you're potentially beginning to build wealth through a home, an asset. It may also be an important stepping stone if you're a small business, a proprietor. Credit is also, and being a part of the credit system, is essential for things including like, can I even access a place to rent, or can I get a job? It plays into so many different facets of our lives, not even just our financial lives. And so the reality is, in the United States, we have a lot of people in this country who don't have a sufficient credit history to even be recognized in the credit system we have when our credit system has been built, and understandably and very productively, on history of credit payments, payments of debt, payments of credit usage. And so Gravetta and I had worked together when I was sitting in the US Treasury Department, and we were contemplating what are these other types of data and the types of analytics that might actually enable industry stakeholders, but also policymakers and regulators, to think about how we are efficiently and effectively bringing more people into the financial system. And so what we do at FinReg Lab, or a DC-based nonprofit research organization, is we really look at and test where data and technology may be instructive for doing things like prudently extending credit to small businesses and consumers where they may not be able to access it with more traditional means. And so some of the work that we have done that we're going to talk about in this conversation is looking at what we call cash flow data. And by that I mean the transaction information that shows up in someone's bank account. We have in this country 98% coverage, according to the FDIC, of access to bank accounts. Now that may be in and out in terms of use of bank accounts, but a core question for industry stakeholders and policymakers is, are those data, again, financial data, are they instructive for assessing credit risk? And that's the research that we did. And for policymakers, importantly, are these data independently predicting risk, or are they at risk of creating a disparate impact and creating this disparity between protected class populations and generally white populations? And so the work that we did in looking at cash flow data, and I'm happy to talk about how we constructed the research, and we can do that in the reception, but essentially what we found is this type of data, indications of a balance, an ongoing balance in your bank account, indications of routine payments, that kind of information is predictive of credit risk. And of the lenders for whom we had data for which we evaluated how predictive is that data, they were actually able to extend loans to consumers who otherwise would have been turned down using more traditional bureau information. As a little interesting sidebar, especially for the bankers in the room, we also found that that data offered an additional insight over and above what credit bureau data would tell you. And so even for populations who had a credit score, that cash flow information was offering an additional insight that was instructive for credit risk assessing consumers and the small businesses we studied. And we did find, as a last sort of top line note, we found that the data are independently predicting risk and not proxying for protected class populations. And that's a really critical factor that we need to think about as we think about bringing in alternative data and making sure that we're using it in ways that are enabling and supportive of equity and inclusion. So I'll leave it there. I'm happy to dig in more on the research that we did, but I think I think it was a really great precursor to some of the work that Gravetta and the team at the OCC have been doing through Project Reach.
I think so too. And
thank you,
know,
for saying
the
that,
thing
Gravetta.
that actually, it's great research, and that's why we asked you to come and help us frame the problem. 50 million people, though.
Yeah, it's a lot.
That's really that number. And I know when we first started, we batted about, I think, somewhere between 40 and 60. So we're in the right place. But one thing, you talk about the government and the policymakers, but we got community advocates who are 100% boots on the ground dealing with people who either are thin file, no file, ergo credit invisibles, or totally credit impaired. And I think the unique thing, at least from my perspective, about this group and this task force is having that perspective to share with the industry and the policymakers. So John Hope Bryant, there are two Johns up here, let me just say. In our Zoom meetings, because this is the first time we've had a in-live 3D meeting in 2.5 years, but in our Zoom meetings, there's John, and then there's other John. So don't hold it against me if I call John Pitts other John. He's accustomed to it. But John Hope Bryant, from your perspective, given the problem statement that Melissa set out, and your experience, dealing with Operation Hope and Hope Inside and the importance of credit, tell me how you see the impact on individuals who just cannot affect credit access in this country.
By the way, the other John, the one with all the money. Melissa, of course, is always on point. First of all, thank you guys for doing this. Hello, everybody. Well,
y'all got to have a little more energy than
so
that. I got to help you on that.
I'm from the black church. The Bible suggests be hot or be cold. If you're lukewarm, I'll spat you out. Translation, even God isn't like mediocrity. I know you're in a government building and you're in Washington, D.C., and you're all wearing proper suits, but aren't you happy to be alive?
Indeed.
Good afternoon.
All right.
Afternoon.
There we go.
That's right.
Thank you.
It's better seen than viewed. You guys are slow. I want to first say, Gravetta, that I think the OCC deserves a lot of credit. You, Acting Comptroller Sue, Andrew, Barry, the whole team. This is not easy, and this is not your chartered mandate per se. Leadership is hard work and subject to criticism, and I don't think that we all realize that we're sitting in a moment in history right now. But history does not feel historic when you're sitting in it. It just feels like another day. But that does not mean the moment is not in fact historic. And what we do now, between now and 2030, I believe is going to dictate the next 100 years of quality of life on this planet, which means everything that we do is relevant. By the way, I want to acknowledge Javon Sterling, I hope I say his name right, the brother who was up here, brother, translation for you, black person, who was, who the banker was up here speaking in the last panel, who was brilliant, and I agree with everything that he said. So let me be specific, then answer your questions. I think it all dovetails together. I walked in today, coincidence is God's way of remaining anonymous. I walked in today to the OCC, and the young lady that's standing at the front door, her name is Essence Spencer, I believe is her last name. I believe she's that back here to the right. Well, Essence Spencer, who's now blushing, 4 years ago was an intern who you guys went to an underserved neighborhood, found brilliance. Not charity, not a handout. It's really, really smart, just unseen in opportunity. And you gave her a shot. This was Comptroller Odding back then, now it's Comptroller Sue continuing this. Gave her a shot. It was a short-term program. You guys decided to extend it, paid her a living wage, gave her an opportunity to show herself. I walk in, she's now here 4 years later. What does she say her career is now? She's gonna be a project manager for the OCC. Stand up, Sterling. Stand up, Essence. Stand up. And I just put you out on my social media. So 3 million people now know your story that didn't know it before. But this is an example, I think, of moving from talking about oppression in the streets to opportunity in the business suites. The new color is green. It's not black or white or red or blue. It's green. And we've got to figure out whether we're better together. That's really what we're talking about. We have to figure out, once again, we once knew we were, whether we're better together. Because there are countries that want us to believe that we aren't. The Bible says we're a house divided cannot stand. There are countries that want our place in the world. They can't take it on a fair fight. They can't win on a fair fight. We're pretty brilliant here in America. But if we spend each other time beating each other up and fighting over stupid stuff, then we will give up our position in the world. Second example of the OCC. About 3 months ago, I believe it was, Sue and I were talking about cryptocurrency and digital currency. We did a summit, which I'm sure many people thought we shouldn't do. It was prescient. I mean, we did the summit about the risk of the downside of people using their rent money to buy cryptocurrency. We now find that half of those who are buying Bitcoin, sorry, not just Bitcoin, cryptocurrency, are using payday loans. Let that sink in for a minute. Let that sink in for a minute. So right after we did that summit, the world for crypto sort of imploded. Have nothing against cryptocurrency. It is part of the future, but it has to be approached in an appropriate way. And I think it actually benefits from government regulation. I think there'll be more value that comes once the government gets their hands around it. But we have got to figure out whether we're better together. But once again, OCC's out front. And now with Project Reach, which is extraordinarily unique for a regulator to do. And we're talking about credit invisibles, as we should, but we're also talking about credit impaired, which is what you refer to. I have 200 offices in the country, Operation Hope. We're the largest on-the-ground platform for financial inclusion in the country. I also want to just give Jesse Van Tol and his organization some love. He's here somewhere. They do great work on the policy side and community reinvestment. And in many ways, we benefit together from the tension and the execution. But our work on the ground is, we have 4 million clients, $4 billion we've moved into underserved neighborhoods in 30 years. And we're making a business case. Here's a couple interesting points. What's the #1 group dying in America? High school educated white men.
Yeah.
Did you hear me? High school educated white men, opioid addiction, rural white neighborhoods where they're depressed. They're locked out of the free enterprise system, locked out of opportunity. And by the way, 76% of those who assaulted the Capitol had financial and economic stress underneath them. Half of Black America half of Black America has a credit score below 620. I'm gonna let that sink in. I didn't say poor people. Half of Black America, 40 million Black people, have a credit score below 620, which means you can get everything right. Go to church, be a decent person, go to pay your taxes, go to work. You're a really nice human being, and still, half of Black America is locked out of the free enterprise system by no fault of their own, because it's what they don't know that's killing them, but they think they know. Or as Andrew Young, who was on the balcony with Dr. King, said when he was assassinated, said, to live in a system of free enterprise and not to understand the rules of free enterprise must be the very definition of slavery. Where was George Floyd murdered? 500 credit score neighborhood. Interesting anecdote. Go to all of these unfortunate shootings of blacks at the hands of police. In neighborhood where they lived, all of them 500 credit score neighborhoods. Where are the problems in rural white America? 500 credit score neighborhoods. Here's what you see in a 500 credit score neighborhood. A check casher, next to a payday loan lender, next to a rent-to-own store, next to a title lender, next to a liquor store. Can I get an amen?
Yeah, you can.
Next to a pawn shop. Help me out.
Amen.
Next to a gun store, next to a 7-Eleven. Don't pick me up. Dang. 7-Eleven. That's wrong. But this is target marketing.
Yes.
They are targeting people who fit urban and rural, Black and white. I think that there is 2 to 3% of untapped GDP. Forget morality and we should love each other and all that. Put that aside for a minute. There's 2 to 3% of untapped annual GDP locked at the bottom of this economic pyramid. You unlock it, we figure out we're better together. The economy just takes off. And we're at Operation Hope, raising credit scores 54 points in 6 months, 120 points in 24 months. Nothing changes your life more than God or love than moving your credit score 120 points. By the way, there's never been a riot in a 700 credit score neighborhood in all of America's history. Because 700 credit score neighborhoods don't riot, they go shopping. You guys have a sense of humor. It's amazing. You're alive. My daddy, my father, Johnny Smith, we lived in South Central LA. He owned his own business. And his credit score sucked. He wasn't credit invisible, he was credit impaired.
Right.
He was, on a good day, 600. He's probably in the 500s. And only way he could get a loan is he had to go to the auto shop around the B paper auto loan around the corner. They'd carry the paper. The interest rate was so high you get a nosebleed. And they only called him when he didn't pay. Sorry, let me repeat that. They only reported to the credit bureaus, you listening to me? When he didn't pay. They never reported all the times he did pay. And he didn't have a Faith Batista. He didn't have the young lady, the Marcio, all these great advocates. He didn't have them. He didn't know that they existed. Didn't have an Operation Hope. So those who make the least pay the most. That's not fair. That's not reasonable. It's not even good for America. But that's the system. So do we need alternative data? You bet. Is credit coaching charity or good business? I think it's good business. What are we doing? We're helping banks get out of the no business. I'm sorry, we decline you for your loan. And back into the yes business. Here, you are approved for mainstream credit. I think that we're talking about something larger here than just some technical nuances. We're really talking about saving America.
I think you're right, John.
And I think we can do it differently.
And we can do it differently. We can upgrade our self-worth. We can reimagine everything. And you can do well and do good. You can do well and do good in the same breath. Last point is that I want to ask everybody, before this day's over, go to the Hope Credit Score Index. It's on our website. We just quietly launched it. We've mapped every zip code in America. We've mapped all credit scores in America by zip code. You will be absolutely stunned. It makes perfect sense. What's the poorest state in America?
Mississippi.
What's the lowest credit score state in America?
Mississippi.
And you'll find where you have crime, drug abuse, murders and mayhem, low GDP, low levels of home ownership, low levels of small business ownership, all the negatives, single parent households, 500 credit score neighborhood. Where do you have stability? Black and white, 700 credit score neighborhoods. I know it sounds weird. Pop the credit score 50 to 100 points, you'll stabilize communities. That's within our grasp. We can actually do that. So yes, you need to deal with credit invisible. It's incredibly important. It's a moral calling. We also have to deal with the tens of millions of Americans who need to be rehabilitated. And that's credit impaired. That's my father.
So I tell you, that connection to how this actually helps the country, and Melissa's statement right there about we can do it differently. So I'm just going to say 4, 5, 6 years ago, I may have had some conversations with financial institutions about utilizing cash flow data, looking at transaction data to make credit decisions. That was probably met with, and if I leave this blank and turn to my friend Mark Brucker, Chief Credit Officer, Chief Risk Officer, what would have been that answer 5, 6 years ago?
Yeah, I'll say that, from a lending perspective, certainly safety and soundness is typically top of mind. Certainly coming out of the financial crisis, I think that's a tough putt to make, if you will. But I think the good news, as both folks have talked about, cash flow data does work. Your research was really good and spot on. Candidly, when we got this group of people together, we had that data. We had it at J.P. Morgan Chase. We had it at Wells Fargo. We had it at Citibank. We had it at PNC.
Next time I'm going to come to you with the data research. Does everybody hear this?
All right. We can always share better. But I think that's the power of this collaboration, which was you hear the passion, you hear the problem statement. And like I said, candidly, as a risk professional, you're trying to solve those problems. And that's what we did here. And there's a lot to talk about. I do want to just sort of hit the ground running. Director Thompson talked about, we got to make sure we're action oriented, and there was a bias for action on this. And candidly, for J.P. Morgan Chase, typically, the risk officer is not going to be in one of these working groups. But when I was asked to do this, it was, look, you guys own the credit box, you guys own policy, you own how to get data. Let's get some traction on this thing, and that's what we did. And when you look at it. Tons of agreement when you get into the room around the power of the data. I would say there's different appetites for speed, there's different appetites for where do we start and what's all included, but we really focused on credit invisibles because we had consensus on that. And we're not going to stop there, John. I know we've had this conversation and we've built a relationship where he can give it to me with that level of directness. We've got to keep going through impaired, and we've talked about that. But we started in a place that really met the safety and soundness. It really met the sustainability for borrowers, and that's important. We also talked about let's not have we want a long-term vision, but what can we do right now? How do we impact communities? How do we get this thing going? And I remember the movie Apollo 13, if you remember that. And they're stuck in space, they got a big problem, and they can only fix it with what's right at hand in the shuttle. Or not the shuttle, I guess the space capsule. And what was in our capsule was pretty powerful. Like, we had cash flow data as the banks. We knew what that was. We had credit policy that was proven in reality, not just theory. It was validated across the institutions. So what we said is, how do we get that out there? Because at J.P. Morgan Chase, we do that for our existing clients all the time. Back to some of the real powerful points about relationship. How do we share that relationship and take the burden off the borrower who's trying to find who's got that data, and how do we make it more available so when they apply for credit, we can have a seamless approach? And in this working group, we quickly came to the fact that we got to make it easy. And we need to think of it as a capability. How can we build a capability that's so easy that banks can just plug into that? And that's what our pilot program does. We launched it last October, and what we do is when customers apply for credit, at J.P. Morgan, we do this in our credit card process today, and they don't have a credit file. We're able to have the credit bureau certify that they don't have a file, and before we inline that application, similar to the business lending conversation earlier, how do we get that information and get that customer's DDA data? If it's on us at Chase, we do that today, but we can't see all the information away from us, and we partnered with the credit bureaus and EWS to be able to go out and get that information. And it's not rocket science. I mean, Melissa talked about sort of what is that? The presence of an account with a stable balance, the absence of negative balances and bounce checks and things of that nature. Pretty straightforward. And what you've got is a demonstrated ability to pay. And based on that demonstrated ability to pay, you get a real-time signal back. Again, this is data that we couldn't see before this pilot. Let's say it's at another financial institution. We're able to take that data, approve that loan, and pull it through our process. That's been happening since October. It's been in a pilot mode. Think about, again, these themes of sustainability, right? Sustainability for both the borrower and for the process and the technology. So that's why it's been piloted. We've been putting water through the pipes to make sure we don't have any leaks. And then we're also watching the performance of those loans. And not to, I think anybody on this stage is surprised, they're performing very well.
Yep.
Yeah.
So, Roberta, just building on this point, and I commend you in the work you're doing. It's not a but, this is an and. Just warning, just to be clear, I'm not criticizing. 85% at operational, 85% of the credit bureaus we pull, there's an error on it.
Okay.
People who have low credit scores don't pull their credit. Let me back up. So first of all, if you have no credit file, Experian, I commend them, they have this Boost product. If you just confirm who your identity is, you'll get a credit score and you'll get a boost on that credit score just by confirming some basic information. They also gave us all the data for this index. And so they're leaning in a little bit. But we also found that those who have a lower credit score tend to check their credit. When you don't check your credit, errors crop up, which then negatively impairs your what? Your credit score. So we found that just by writing a letter to the credit bureau as Operation Hope, because the credit bureaus, if within 30 days they don't confirm that it's yours, they must remove it. Most of the time it gets removed, it pops a credit score 30 points. So this is so simple, but we're not really institutionalizing the baseline information or the financial literacy that people need in order to really participate in the system. Thank you for what you're doing. Thank you for what you're advocating. But this needs to become the accepted norm and not the exception to the rule.
So where do people need to go, John, to get that financial literacy boost that helps them understand what their responsibilities are in order to help, because we've got this solution that's being piloted, some DDA data, and Mark is going to tell me in a minute what type of DDA data is being used in order to do this. And there's not just JPMC, as you said, there's several banks, and each one is on a different time frame, but really looking at this type of solution. But that financial literacy piece that you're talking about, understanding how credit works, how you can control that, where does that land?
So the local level, again, I talked to Faith, but there's a lot of nonprofits at the local level doing good work, and it's easy to find. Just Google search financial literacy and your local community, they'll come up. But I think financial literacy is a civil rights issue of this generation, which is a pretty bold statement to make. It is also, I think, no coincidence that the Freedmen's Bank, chartered to teach free slaves about money in 1865, was actually regulated by the OCC, which is another piece of lost history. And that was financial literacy circa 1865. Me and the CEO of Walmart, Doug McMillan, have now co-chaired something called Financial Literacy for All. 2 missions. Get this embedded into corporate America, 80% of Fortune 500s in the next 12 months. We've already gotten 60 of the biggest companies in America to say yes. This is not charity or philanthropy. This is them embedding this like healthcare was 50 years ago. Financial well-being, coaching for their employees, making this available to their customers. So not just banks now, we're talking about really mostly non-banks. Secondarily, to get legislation passed, so this is embedded in school systems. I won't go off that conversation right now, but both these tracks are moving. But it's the Fortune 500 that actually is now seeing this as a business case, financial literacy. Not a charity case, not a do-gooding check. This is a CEO saying, this is now come, 95% of all employees are financially stressed on the job. 95%. So this, and by the way, a quarter of all people living on paycheck to paycheck make $250,000 a year. A quarter of all people make $250,000 a year are just living from paycheck to paycheck. So this has now become a mainstream issue that affects all of us. And I think this is the civil rights issue of this generation. And luckily it's going beyond banking, but this should become the holy grail of banking because of clearly in financial services because of what you guys do. So I think all this stuff is interconnected.
So you got the banks that have access to the demand deposit account data, working to come up with the pilot, looking at that data. What type of data is it, Mark?
It's pretty straightforward. Again, you're looking at balances on the account. You're looking for positive balances. Each bank will have their own criteria, but generally you're looking for a minimum threshold that I think most people would find pretty reasonable in the sense of we're talking hundreds of dollars, not thousands. And again, it's the absence of negative information. I'd love to tell you that it's some slick machine learning AI algorithm that's doing some crazy things that you've never thought of, but it's pretty intuitive.
Well,
It's going to be the fact that these people are responsible with their own money, and we should give them the opportunity to borrow money, and the data tells us that they're responsible borrowing money as well.
I just want to add on to that. It's helping us get beyond what is an indication of credit risk, which is income. Yeah. It's helping us understand how somebody is managing their finances, yes. which is there, whether they have $250,000 and maybe they're doing it poorly, or they've got $60,000 or $30,000, and it's that kind of leveling the playing field financial data insight that I think is really powerful for bringing so many more people in. In the research we did, we had 2 CDFIs who participated. One of the CDFIs was doing cash flow analysis. They were literally taking paper receipts. I can say this, it's been a few years since we've done the work. No, but they were literally taking paper receipts and paper statements and then themselves, as the lender, digitizing the information.
Wow.
The richness of the insight from that data, they actually had some of the strongest AUCs in the, the indication of ability to understand the risk by the data that they were taking in, and it was paper information on low to mod income consumers in that community in Chicago. So really powerful data that we should all really be paying attention to. One other point I'll make, and Dave, we've talked about this, there are also millions of people in this country who are using prepaid cards, general purpose reloadable prepaid cards. That's a transaction vehicle. For a lot of people, that is an alternative to a bank account if they may not be able to get a bank account. That is instructive as well. We suspect, we haven't done the research to prove it yet, but globally, transaction data is routinely used for assessing credit risk. And so there's just a real powerful opportunity, not to mention the timeliness of the data where we have lags with bureau data, et cetera, et cetera.
Because it is real time, right? This is showing you real time money management by consumers and how they're able to take whatever amount of money they have coming in every month and making all those
how they're
ends
making
meet.
those decisions.
Right.
Financial decisions too, not where did you shop or what did you buy? Because I think there's a lot of anxiety about this data that we're going to be looking at, in sort of a surveillance kind of way. What are people doing? And not saying from an empirical standpoint that might not be instructive, but that's not the kind of data that we're talking about here.
So when we talk about this DDA data, but there's other alternative data, right? Other alternative data that may actually give us indications about ability to repay. Rich, what kind of alternative data do you think could be helpful in this journey as we continue to try to figure out ways to help credit invisibles?
Yeah, I mean, first of all, it's kind of like, what is a credit invisible, right? I think anyone leaves some sort of footprint somewhere. And so I think the thing to do is to look at those places where people leave footprints and look at that data. So obviously, demand deposit accounts is one of the things that's really hot in the industry right now. I think a lot of the major banks have been using that data for a very long time on their own customers. But if you're trying to get into the financial system, you don't have a bank account with Chase. That's very tough to do. I think some of the stuff like Plaid has made a lot of progress for people that don't have these mainstream accounts, and obviously the EWS solution that Mark led us through and the Project Reach work is transformational there. But that's just one dimension. So another dimension is the alternative credit bureau data, and it's hilarious that we would consider someone credit invisible if they have some sort of credit bureau data. But the way this works is that, when I got my Chase Sapphire Reserve card that Mark's team approved me for.
Relationship capital.
Mark's team, went out to the credit bureaus and pulled my profile and underwrote me based on that. If someone in these FICO 500 neighborhoods that John's talking about goes and gets a payday loan, they also go out and pull credit on that person when that person gets that payday loan. The thing is that those are different credit files. Those are completely separate credit files, even though they're owned, in some cases, by the same company. So the same company owns the payday loan credit file and the Chase Sapphire Reserve credit file and doesn't mix them together. Essentially, we've created this segregated class of consumers where it's like the people that get to be in the good file and the people who get to be in the bad file, even though it's the same company. This is crazy, right? This is like, we would look at this as alternative data because it's not in the main file. That shouldn't be the case. We should not look at that as alternative data. We shouldn't even look at these people as credit invisible. And by the way, just as an interesting side note, at Credit Karma, when we started on this Project Reach work, I looked at what can we do into Credit Karma to kind of test some of these hypotheses and make some progress here. And just a quick diversion so that this story makes sense to you guys. We have this thing called Lightbox, and basically what it is it allows our bank partners, many of the people in this room actually, to come into our platform, code up their marketing eligibility in our platform, much as you would do in your direct mail campaigns, and then we market consumers on our platform based on your eligibility rules. To do that, we need to have all the credit bureau data. So we have tri-bureau credit bureau data, and we went out. So at the beginning of this Project Reach thing, I went out and said, all right, what let's buy some alternative data and see what happens. So we went out and bought 2 major sources of alternative credit data from the major bureaus. We went and bought a third one that's completely independent. We bought some data that's typically used for fraud. We put that in our platform, and then we told our lenders, and by the way, we took some data that we had as well, and just stuff that we knew about our own customers, their income, stuff like that. And we went to our bank partners and we said, use this data and see if you guys can do a better job of assessing eligibility. And literally every single lender that played with that data, and literally every single time we brought in a data source, we increased eligibility. So we were able to offer more mainstream credit products, either deeper in the FICO spectrum or on better terms, lower prices, whatever. Every single time we increased the amount of data we had. And it's weird because we brought in data, in some cases this payday data, people would say, well, that's, if you're getting a fancy credit card, alternative, this payday data may not be exactly a good thing, right? Doesn't matter. We increased eligibility every time we brought that data in. And so I think the point here is for all of us in the industry to think about, don't just think about the main credit file. Think about the alternative data files. Don't just think about the alternative data files. Think about other stuff that's out there, the way people pay their taxes. You can buy data on email addresses, right? That's like one of the most interesting things. I've had the same email address since I was 18 years old. That's a sign of stability. By the way, I'm not a stable person, by the way, and I'm much older than I look, but that is a sign of stability.
I like that sign of stability.
I think the key is every time you bring in additional data, you're able to get more eligibility, offer more mainstream products to people who would otherwise be walking into that payday shop in the FICO 500 neighborhood.
So you're brilliant.
Thank you.
So you got me thinking. If you pay your insurance premium, if you're not paying the insurance premium one and done once a year, most people need to spread it out. If you're paying it every month, which most people do, isn't that a form of credit? It's not reported. There's a lot of mobile phone bills not reported. Utility bills not reported.
Netflix.
Cable.
Netflix.
I was going to say cable.
Now, if you don't pay, they knock you over the head, and again, they do what Johnny Smith they do with my father and report the negative stuff, but not the positive stuff. We got to realign the incentives and the penalties. Clearly, there should be a penalty if you don't pay, but there should be an incentive if you also meet your obligations. And what you just mentioned is so simple, but not being done.
Yeah, and you know what? I picked on the credit bureaus a little bit, so sorry for my credit bureau friends in the back. I see a couple over there. So I'm going to pick on our regulators for a second too.
You want to pick on us? I'm good.
I'm going to pick on you because I don't work in a bank anymore, so I can.
Okay, all right.
When I bring this to a lot of our bank partners and say, hey, could you guys use this data? And they all said the same thing, which is, I'm terrified. I don't know how my regulator is going to respond to that.
Oh, yeah.
That's what they always say. And I think that, given that more data tends to increase eligibility, I would love it if our regulators were more out in front of this saying, guys, there's this great data here you should be using. We think it will expand access to credit because empirically we've observed it too. And so I think we could do more of that, Gravetta.
Yeah. So Gravetta, can we get to the how do we get all this extra data into the system here?
I think, why don't you go with that, John? Other John.
Yeah. So now everyone knows why I'm Other John, though I will try to be half as provocative as John was here, which I think is still extremely provocative for an OCC conference room.
Rich people don't need to talk much.
So what Mark described is fantastic, and we sort of within this group refer to it as the MVP. Not the most valuable player, but the minimum viable product. And that's not meant to be a slight at it. This is the way most innovative companies and innovative banks like Chase think about this thing. You get the MVP shipped out, and then everything from that point is a yes and that spirit of yes and has been one of the most powerful things in this group. So we've got this MVP. What's the yes and that comes from that? Well, where are the gaps, right? Melissa already referenced one of the gaps, which is there's great DDA data, but what you really want is transactional data from everyone, and roughly 26% of the population is probably not covered in terms of being able to get that DDA data into this MVP. So we've got to have something that gets that 26% in. And the 26% is important because, as John knows, the folks who are going to be credit impaired and credit invisible are far more likely to be in that underbanked or unbanked world where they're using a general purpose reloadable card as their transaction history. So one, you need something that gets you that.
Or now Venmo.
Or Venmo,
Or now
right? Or Venmo or Chime or something like that, right? So you need all of those other sources of data out there. You need to follow the consumer where they are. 2, more data, right? And the really nice thing about what Melissa's talking about in terms of transaction history as opposed to sort of narrow DDA data is, John, the stuff you were talking about, paying your insurance. If you're paying your insurance with a general purpose reloadable card, that transaction's on the card, right? You don't need a specialty credit bureau for it. You can see the payment history that you've made those payments. You can see all of those transactions, and you can derive from that transactional history not just the cash flow, but what are you using the cash flow for? I think, Melissa, not the like, oh, you bought a Sprite, you seem like pretty credit risky to me. Not that Sprite, sorry.
Or
is an indicator
7-Eleven.
that, right, or 7-Eleven. You brought a Sprite at 7-Eleven, oh God, like, sorry, you're out forever. So you need a way to get more and richer of that data. And you know, the previous panel talked about it, consumers and small businesses have gotten more comfortable with providing more and more of that data in order for credit. But this, to Rich's point, like, the third thing we need here is there is a regulator element as well, right? Which is the consumer has gotten more comfortable with this. Fintechs in general are certainly very comfortable with this idea of ingesting lots of data from lots of different sources. Banks have been increasingly comfortable with this idea. But the reality is a bank is only as comfortable as their regulator is comfortable. And what that actually really means on a daily basis is the bank is as comfortable as their EIC is comfortable. And so making sure that each EIC understands that, I'm sorry, I'm a terrible guest.
You're not a terrible guest. I'm just looking at my favorite EICs and deputies over here for some of my banks. But I don't disagree with you. And what I think a really great thing about Project Reach and the way these work streams have been formulated is we are in our role as convener. This is certainly separate and apart. And it's important to say this. It's separate and apart from our supervisory responsibilities. We are not, you know, in any way going to examine and saying, and yes, if you're a part of Project Reach, you get a different
No.
That's not it. But what we are able to do is be that timely reminder about what the regulations actually say.
The beautiful
and
2019 guidance.
Sometimes I have to report out what the policies are and what they're not, based on urban legend that we had to dispel early on in some of our conversations. Our policies don't actually require that you go and pull every single credit bureau from everything. It doesn't say that. We talk about safe and sound underwriting. You know, we went out back in, you know, the lost guidance, as I like to call it, back in December of 2019. When we issued across the agencies guidance that said, hello, guess what? It's okay to use cash flow data for a different purpose. Because you're right, we recognize that in some places the industry is trying to innovate, but they definitely want, is this okay? The first time I would say myself and my agency partners got, you know, feedback that, you know, the banks really do want to look at this transaction data, but they're not certain that you guys are going to be okay with that. Like, I've been talking to them about using transaction data for years. We have, but it doesn't say that anywhere. So we do have to move forward and write it down.
But that's the beauty of these, I mean, the convening that you all are doing. Right? I mean,
That's
it's,
exactly right.
it's putting this on the table. It's doing it where you've got lots of different stakeholders talking about the opportunity, the challenges, and there are challenges. We all know this well. There are challenges in the use of this data. But the convening power of everybody at the table to talk about that and where there are potential solutions, whether it's market practice or evolution of policy,
right?
That's what is exciting about what comes next.
I was going to say, I think it's the pace of change too, right? So John and I may differ on the speed of the journey.
That's okay. We're going to sit next to you during the reception.
During the reception. But a lot of what we're doing is making sure that it is sustainable for both the borrower and that we've built the right operational controls so that our good intentions are executed with precision. And I think that's a little bit of the friction sometimes we feel. And making sure this is scalable. The other big thing is, I hope I didn't give the impression that our first foray here and all the good work that we've done is sort of the destination. I'm not sure we ever get to destination.
I think that's important to know.
And we definitely view this as an and type solution, right? So you see sort of like, let's get the low-hanging fruit, let's get traction, let's really make a difference here. That's a multiplier. It's a force multiplier. Can we make it easy, back to this capability, and let other institutions get to this data without having to do, I'll say, as much heavy lifting? And if you think about the points that were made about the credit bureaus, there is other data out there, and that's part of our thought process as we move forward. Is okay, how do we combine our efforts to vet that information and get some synergy so we all don't have to do the same amount of work? And more importantly, how do we leverage our knowledge of how a bank works and how a bank processes information, and can we make that easier? So again, JP Morgan and some of the other large institutions, we have a lot of resources. They are not unlimited. Technology is a challenge for everybody, but trying to build those capabilities that you can really push it out across all size banks and do that heavy lifting. And I think there's some exciting things here. We're talking about some of the challenges, but there's a ton of opportunity there. And I would say when I leave these meetings, more times than not, I'm optimistic. And you really see some cool things, and the points on payday lending and other parts of the bureau are spot on, and we just got to keep focused on those, and I think we'll get those as well.
I think
Mark,
go ahead.
Yeah, there's one more thing in terms of the both challenges and opportunities that I think we should actually be pretty explicit about here, which is as we talk about a consumer wanting to share and deciding to share more data into a system in order to get better access to credit products, there is a trust gap that we need to make sure that we close in that. And John, you talked about this, right? 84% of consumers have something wrong in their credit file. There's a reason there's a trust gap, and often that lack of trust ties very tightly to communities who have been historically excluded, right? They have a reason that they do not necessarily trust the system. And so just saying, add more data to the system, share more of your personal financial data, the most confidential data for most people other than their health data. And so I think there's an element here where figuring out the ways and making sure that we do this where the consumer has the transparency into what additional data they're sharing, has real control over that data. Not just transparency, but control. And then, John, I know you've been passionate about this. You've really ignited some of my passion on it, is give them not just the transparency and the control, but the tools to do something with the data and the answers they get. So you say, yes, I'm willing to share this data. I'm willing to see what data it is. I'm willing to check the data, make sure it's accurate. I'm building in a little bit of extra friction to the process. And that is one of the challenges we face is, how do you build in those consumer controls to get more data in while still making it a feasible underwriting process for the bank? But then if the consumer sees information that they don't like and they want to do something about, how can you have a seamless handoff to an organization like John's where they can then get credit repair help, they can then get assistance, they can get that sort of step up the ladder, which is how we often talk about it in the group, to make sure that they have actionable information when they're given that transparency and control over their data. And I think we can't, as a group, say, just turn over more data to us without having a real engagement with why you should trust that. And to me, that ultimately comes down to giving the consumer more control and transparency into what's happening with their data and building that into this system from the ground up.
So that permission that the consumer is going to give, right? Use my data to help me. But I'm going to go back to John's example about his father when you talk about trust. The trust gap is, I have data. People have data about me. They're making decisions about my ability to repay based on this data they have. But if all the data that they seem to have has always been negative and hurt me, why should I then turn around and trust you? Which takes us to, I think, an interesting place about, the solutions, because EWS and the pilots being worked on by some of the largest banks, that's one solution. But our conversations have always been about, there's got to be many solutions. You got 50 million people. It can't be a one size fits all. So one thing I think people are probably concerned about or want to hear about is when you get this data, and we're all talking about doing good. We want to collectively do good. We want to help people. What happens if the data is not so favorable? Can it hurt? And what are we doing with that? Because I think that's something that we need to be mindful of as we go through these processes.
I mean, for us, the process as it works today at JP Morgan, you're going to have a second look process, right? So you don't have credit to evaluate. We pull this data in. If you have negative data, i.e., you don't have a sufficient balance, or you have, let's say you have NSF checks or overdrawn, we will include that in our adverse action and we'll cite the source. So you as a consumer will know that we got the data from EWS, and in that data it says that your account either had an insufficient balance or it had negative information. You're going to get the address for EWS, and if you have a question about that, you're going to go ahead and that would be your path to validate that and potentially dispute it.
Okay.
So there's a couple of things. Well, we want these sort of light switch changes in our life. We just want to, just as they said, either regulator, just change it. But
I wish it was that easy.
But the reality is, Dr. King gave that "I Have a Dream" speech 100 times before the March on Washington. No one talks about that. 13 years of speeches, 6 million of air miles, 2,600 speeches. Let's just remember that one. All I'm saying is that this stuff takes time, as you said, and you got to keep pounding at it and pounding at it. And sometimes it's the nonprofit working with the bank to get the solution that you want. We have a policy at Operation Hope that we approve you subject to the resolution of your primary denial factors. We, Operation Hope. So the bank doesn't fund you, we will. But we also know why the bank's telling you no. And so we sort of back into the approval from the lens of all of your challenges. So even with data that's not all that elegant or wonderful, we've been able in most times to turn that around and get you to a point where you can get prime credit. But here's my point on that. How did we even get into the bank branch? Because I had to write a letter to the FFIEC. Mark Pierce at the FDIC took the lead on this and said, I want to operate inside of a bank branch. They thought I was nuts. A nonprofit operating inside of a bank branch. No. But we made the case for it. FFIEC approved it. We became the first nonprofit allowed to operate inside of a bank branch with CRA credit. And we worked separately from the bank to then create this situation where we could turn somebody from a no to a yes. Went from small banks that nobody knew about. Now we just cut a deal with Wells Fargo to be in the first money center bank on a scaled basis. So now it's normalized, and I sit here on this stage as part of the normal process, but it wasn't normal when I started.
Right.
This was abnormal when I started. In fact, it was rejected. So sometimes you got to work hard at these things and just never give up and never give in and keep until you can make something abnormal normal.
So this is where we are. And I know I'm looking at Andrew, I feel like I'm about to get the hook in about 3 or 4 minutes. All right, but before you give me the hook, Andrew, and you guys be patient, I know this last 3 or 4 minutes is what's standing between you and a reception, right across that. It's not far, so just be patient. But when we sit back and we look at where we are today, and we're thinking about, it's gonna take time, but I can see the change. I mean, and federal government banking agency, dog years, it's pretty rapid. To see, going from the no to looking at, all of these sources of data, as you said, Rich, all of this information that the consumer can now, with a little bit of friction, but feel more comfortable giving this up, saying, okay, look, JPMC, here, I'm signing on to this. Go see if you can hook me up and get me good credit, even if it's at, this beginning stage, because I can grow with this. You want to see me grow with this. It's the sustainability that Director Thompson talked about earlier today. Because it's not enough just to give you access, is it? I don't think any of us believes it's enough to give you access if the education, if the data points, if the help and the understanding isn't there. So this is where we are, rapid fire down the line. Where do we go next?
Oh, this is not an open finance, a rapid fire group.
Rapid fire
okay,
group?
So where do we go next? So open finance is here, right? We are dancing around the cusps of it, but the CFPB just announced today they're accelerating their 1033 rule. So like open finance and this consumer controlled flow of data is here. Next steps for us, I think, start piloting some of these solutions. And I think open, not we've already got one pilot out, but open means regulators figuring out how banks and non-banks can pilot together under the eye and sort of appropriate reporting of the regulator. Really demonstrate these rapid proof of concepts within that safe space of a pilot, and OCC's got great pilot programs. That type of, if open finance is here, we need to start showing the proof in the pudding and showing how banks and non-banks can safely work together, work with data networks like Plaid to sort of have all this data safely move with the consumer. I think that's the next frontier.
All right, Rich.
Yeah, for me, I think it's time to start experimenting. I think the fintechs have been doing this for a long time. Some of the fintechs are using 10, 15, 20, 25 different data sources to underwrite an application. A lot of the banks are still using one, right? I think the banks, I would love to see you guys out there talking to your regulator, finding out what they're comfortable with, and just trying things and seeing how it goes. Because I know, I've seen it. I've seen the ones that have experimented have been really, really excited about the gains they've made, not just in terms of serving credit invisibles, credit impaired, whatever, but also in terms of their own business. I mean, they're building real businesses that are contributing to their profit off of these experiments.
John.
The Bible says where there is no vision, the people perish. Dr. Heen didn't go to the mall and say, I have a dream that GDP will grow by 2% a year. But oddly enough, that's where we are. Melody Hobson would say that she loves math because it doesn't have an opinion. I think we should be obsessed with the math right now, because the math will show you that if you just focus on the fact that you want to grow economy by 2 to 3% a year, which is what we need additional, you got to get that from the bottom of the economic pyramid, the credit invisible and the credit impaired. So if this is not Project Reach, but Project America, and every bank and all the regulatory agencies decide to model what you've done at scale, how do we sustainably, rationally, on a safe and sound basis, mainstream, and probably 100 million Americans, rehabilitate them or prepare them to move into the mainstream financial system and the economic contributors? That's good for everybody. You create taxpayers, you create homeowners, you create small business owners, you create employment, you create entrepreneurs, you create sustainability in this country. All boats rise. With the light that hit me today on is that this is not Project Reach. This is not some niche thing. This is not even the OCC. This is bigger than you and bigger than Reach. This is Project America. This is how we save the republic. This is how we get everybody to agree that we're better together.
I like it. Mark.
I would say it's nice today to meet everybody in person. I think there was a little bit of a celebratory element, because I think we've done a lot of good work. I think I just encourage everybody to remain dissatisfied. Let's keep the energy going, and hopefully you heard a lot of great ideas in all the panels, but there is definitely more work to be done.
Absolutely.
And
Melissa.
I can't help but be the pragmatician here. More policy dialogue, more research, more of what we're doing here, because there is a lot to sort through, a lot of opportunity, but it's really exciting that so many different stakeholders are motivated to get after this, and to make sure that we're bringing lots of other banks and non-banks into these conversations. That's really important too, long tail. Thank you.
I gotta thank you all for a wonderful